Namaste, everybody. Good afternoon. Hello, ladies and gentlemen. Congratulations. We've made it to the year 2022. And why am I saying that? Because this is a year born from times that can best be described with the lines from A Tale of Two Cities. They go like this. It was the best of times, it was the worst of times. It was the age of wisdom, it was the age of foolishness. It was the epoch of belief, it was the epoch of incredulity. It was the season of light, it was the season of darkness. It was the spring of hope, it was the winter of despair. We had everything before us, and we had nothing before us. In short, the author, Mr. Dickens, seemed to have described and fast forward the years 2020 and 2021. What a time we, the people of the world, and we, the people of India, have lived through. It was big, but it is past now. जीवन में एक सितारा था, माना वो बेहद प्यारा था. अंबर के आनंद को देखो, कितने इसके तारे टूटे, कितने इसके प्यारे छूटे. पर बोलो टूटे तारों पर कब अंबर शोक मनाता है. जो बीत गई सो बात गई, जो बीत गई सो बात गई. For all of us humans who've endured and survived, a big cry of victory must be let out. We've made it. Know it, feel it, relish it, and most importantly, seize it. The year 2022 is the year of the water tiger, a year that occurs only every 60 years. For those of you who believe in astrology, the zodiac sign tiger is a symbol of agility, focus, judgment, might, and bravery. All things we will need going forward as we begin to craft a new future for mankind. It is time to look ahead and build a whole new world. So to talk about how to build a whole new world, a new India, I, Geetika Ganjudhar, welcome you all to the Mint India Investment Summit and Awards 2022. The event has been themed Investing for India, where the discussions, deliberations, and debates would circle around transforming India through strategic investments. Driven by demand, demographics, development, the 3Ds, the world's largest democracy is set to emerge as a global business and investment destination as it celebrates 75 years of independence, Azadi Ka Amrit Mahotsav. How can we build momentum for transforming India, asks this event that brings together the most influential industry experts to explain the current challenges and opportunities in various sectors and devise the investment landscape ahead. So let's begin. This event is it's happening here, but it ain't really happening until it's happening online. So please follow, post, and share using the hashtag Mint IIS 2022 and tag us at LiveMint. Also, we cannot begin the conference without a huge shout out of gratitude to our partners, TriLegal and MobiQuick. Thank you to you. Thank you. And now to open house. May I invite the man who opens, closes, and navigates all that is content-worthy at Mint. Let's put our hands together and welcome on stage Sutajit KK, Editor-in-Chief, Mint, for the opening remarks. Good afternoon.
Thank you, Geetika, for that wonderful opening, combining philosophy, poetry at a summit which is fundamentally about money, capital, technology. I think it provided a great contrast. Thank you very much. Good afternoon, everybody, and a very warm welcome to all of you to the India Investment Summit 2002. What an exceptional year this has been for India's investment landscape. 2021 broke every fathomable record as far as deals and investments are concerned. India has now emerged truly as a hub of entrepreneurial activity where exceptional founders are building for the world. And global capital, which has realized this, is making a beeline for India in search of opportunities and returns. Those who placed bets earlier have harvested rich gains as well as the envy of their peers. I'll take you through a few data points to illustrate what an extraordinary year 2021 has been. $77.1 billion. That's the total amount of investments in, across private equity and venture capital that has come to India. That's up 60% from the previous year. Of this, just 3 segments, technology, e-commerce, and financial services, accounted for 57% of that amount. So you see the concentration of activity across these 3 segments. $43 billion worth of exits delivered by PE and VCs to their limited partners, which is up 7 times from the previous year. And this is so critical because this is what prompts the subsequent waves of investments from limited partners and from capital around the world. Sorry, let me make sure I have the right slide. Yeah, 13 billion raised by private equity-backed IPOs. There were 44 such IPOs in 2021, quite an exceptional harvest. $28.5 billion worth of investments into startups, the segment that saw an extraordinary amount of action. And that is up 290% from the previous year. And I really want to show you guys the next chart. Yes, look at that, the way that chart is shooting up at the end. 10 unicorns, this is the number of unicorns that's been created every year. You see that amazing number of 44, which is what 2021 saw. And it's projected, this is an EY, Ernst & Young projection, next year, this calendar year in 2022, it is estimated to go up to 70. And that's based on the very large number of Soonicorns that they have. So by any measure, an extraordinary story of capital flowing into and helping create world-class businesses out of India. I think we are very fortunate to be witnessing this incredible jugalbandi of technology and finance. There are, however, now clouds on the horizon. There is rising inflation around the world, and there is uncertainty of war and oil prices. So we'll have to see how some of these optimistic projections actually turn out. Over today and tomorrow, we have curated a number of panel discussions and fireside chats with insiders and experts to understand the forces shaping the present moment as well as the emerging trends. Thank you for joining us, and I hope you enjoy the summit.
Thank you, Sudhajit, and we are all indeed looking forward to the jugalbandi of technology and finance, as you just said. Thank you very much, and of course, welcome everybody, ladies and gentlemen. Let's move right into the opening keynote by Shri Rajiv Chandrasekhar, Union Minister of State for Electronics and Information Technology and Skill Development and Entrepreneurship. Shri Rajiv Chandrasekhar is a Member of Parliament and a Union Minister of State in the Ministry of Electronics and Information Technology and Skill Development and Entrepreneurship. He has been in public service since the last 15 years. In his early years, he worked at Intel as a senior design engineer and a CPU architect on the 80486 and Pentium microprocessors. In 2009, he founded the Flags of Honor Foundation, a foundation that supports martyrs' families and serves as a platform for citizens who seek to help the families of martyrs. in Parliament. Rajiv Ji is a vocal advocate of governance, technology, and economics. Rajiv Ji focuses on reforms in economy and governance, technology and internet, issues related to youth, and issues concerning national security and sustainable city governance of Bengaluru. We have him with us virtually. Ladies and gentlemen, even then, please welcome him on screen with a round of applause.
Good morning, namaskar, and thank you for inviting me to the Mint India Investment Summit 2022. It is a pleasure to be here and to be amongst all of you, and to have an opportunity to lay forth in front of you my ideas and thoughts about India and its economy and the direction in the coming years. I understand it is a bit of a hybrid event, and that marks the baby steps, hopefully, to meeting and engaging physically as we move down this road of emerging out of this really terrible and disruptive event of COVID that has impacted all of us, and indeed nations and peoples all around the world. I understand amongst the crowd are savvy investors and people who understand the economy very well. So let me just lay out from where I sit and have a view of the economy and where we are going and how we've reached here and what directional cues we can see in the government. Let me just lay out my views for you, and I'd be happy if that contributes to your overall thinking and assessment of our economic direction. I just want to start with a quick recap of the journey that India has taken economically from 2014 to 2019. For most of you who were observers of the Indian economy and have stayed the course for several years, you will know that the years leading up to 2014, when Prime Minister Modi was given this mandate, those early years preceding 2014 were really terrible years, in the sense there was governance deficit, there was a very, very sharp decline in investor confidence around the India story, even though the demand and all of the stories of the potential India remain intact. The big issue was about governance, policy consistency, retrospective taxation, corruption, crony capitalism, the availability of credit and capital to more than the 8 or 9 groups that had collared, in a sense, the financial markets. So all of that was the backstory to Prime Minister Narendra Modi's arrival in 2014. And from 14 to 19, very systematically, he went about cleaning up the financial sector, recapitalizing the financial sector, bringing a semblance, a very significant sense that credit and capital in this country were not the monopoly of a few. Opportunity was not a monopoly of a few companies or groups or families. And so he set the economy, in my opinion, into a qualitatively different orbit from 2014 onwards, and even the bitterest political critic of Prime Minister Narendra Modi ji will accept and acknowledge that. And we were on track for a $2.3 trillion economy by the end of March 2020, despite all the shocks of the ILFS type NBFC sort of time bombs that littered the Indian financial sector from the legacies of the corruption in the financial sector. Despite all of that, we maintain a certain momentum, and we were to clock March 2020 at 2 trillion plus. And then, of course, this black swan event hit us and hit every country in the world, disrupted global trade to start with. And then in its wake, it took livelihoods off the table for many, many countries and many, many economies. And we went into this in that first quarter of 2020, really like most of the world, flying blind, not knowing what this virus was about, not knowing what the depth and intensity of the crisis would be, and and clearly, like most nations and most people around the world, not having the clarity of how this would pan out and play out. And I think it is those 2 years, the 2020 April to the recent years, that have, in a lot of ways, in the post-independent Indian economic scene, been very defining years for India. I think we took on this challenge, this unprecedented disruption of lives and livelihoods, and responded in a manner that has made, indeed, the world become very awestruck about the resilience and capability of Indians in general, the Indian government in particular, and the whole Indian economic landscape and entrepreneurship even more in particular. So we have now, emerging out of this pandemic, demonstrated to ourselves and to the world that we have really been a very resilient nation. We have vaccinated over 1.8 billion shots with vaccines that were manufactured in India. We have managed the soft landing of the economy in the early parts of the pandemic, and then address the rebound of the economy in a very calibrated set of policy actions that did not fall into the temptation of whose stimulus package is better, despite so many politicians and so many so-called economists talking about our stimulus package is undersized compared to the other major economies. All of that you are aware of. But the sum and substance of what I was trying to say is that we are currently today the fastest rebounding economy in the world. We are an economy that has attracted the most amount of FDI, and we have, in the midst of all this, created the fastest expanding startup and innovation ecosystem in the world. And all of this just points to the fact that we are now a nation which is reimagining and resetting, in a way, our ambitions as we look forward. And to the investor class of people, the people who are observing the Indian economy and are genuinely impressed with how we have navigated the last 2 years, I say this, that the Prime Minister's vision and the roadmap, whether it is which we broadly title Atmanirbhar Bharat economic model, the infrastructure pipeline, the asset monetization pipeline, and the innovation and digital economy that is expanding, all together point to our understanding of the India opportunity in the next 10 years as being very, very different, qualitatively deeper and better than what we had pre-COVID. And let me take a few minutes and explain that for your understanding. And I'm sure most of you already understand it, but let me give it a shot anyway. There are two things that, from our point of view, are driving, apart from this reimagined or this new resurgent confidence amongst within the government and amongst entrepreneurs and business and citizens in general, is that, one, there is clearly an understanding and there is evidence and there is absolute impact of the fact that the world is now digitizing at a faster rate, and consumers, businesses and governments all around the world are digitizing in an accelerated rate, which again points to an opportunity for India. And on the other hand, there are clearly tectonic, deep structural changes to the way the global trade and global supply chain and global value chains were set up before COVID, and how they are evolving and changing post-COVID. That again points to opportunities for India. And so if I take those two, attached to it the Atmanirbhar Bharat vision of the Prime Minister, which is really about self-reliant, creating capabilities and capacities for India to become a preeminent player or a significant player in global trade, in delivering products and services to consumers and economies and consuming nations of the world. If you look at all of those three things combined, then the Prime Minister's promise of the next decade being India's decade, and the Prime Minister's vision that the next 25 years should really be called Amrit Kal, which is really taking India and this new India to the next level in terms of economic opportunities and economic growth, all will start making sense. Let me specifically dwell on the two aspects. One is the technology part, the digitization opportunity of the world. And you can see already after many years of sort of slow, low growth, the IT sector this year has clocked over 15% growth. Just points to the increasing demand from the world and the nations of the world and the enterprises of the world and the consumers of the world for more digital products and digital services. And in a lot of ways, we are now constrained by talent, and that is a separate topic that I will hopefully discuss one of these other days in a separate program. But it is clearly that the demand for our services, digital services, is at an all-time high, and I predict and I project that will continue to be the case as the demand diversifies around the conventional IT service, from the conventional IT services to the other technology services, solutioning, and the products that the consumers and enterprises around the world will need. The second piece is the electronics and the supply chain piece. It is clear that the world is now looking at diversifying away from the dominant role of China in the electronics global value chain of electronics. It's a $1.7 trillion market, of which 60 to 70% is China origin. And I think there is clear evidence post-COVID that there is an attempt by almost all of the large electronics multinationals and global companies to seek a diversification of their value chain and supply chain. This not only provides opportunities for India to be growing its manufacturing capabilities and capacities, which have significantly grown in the last 5 years, to taking that to another level, and our goals are to take it to 300 to 350 billion by 25-26, which is electronics manufacturing, of which 120 billion will be exports. So that is the roadmap that we have built, that has been carefully built with great consultation with industry and all of the companies that are actually stakeholders in the electronic space. In addition to creating investment, jobs, and employment around the manufacturing space, it also throws up a very, very interesting set of opportunities around electronic system design, the innovation ecosystem around electronics, which is again dominated by a few countries until COVID. So in this post-COVID new normal, in this new sort of new world order, I think India can play a very significant role and will play a very significant role in the whole electronics manufacture, design, and innovation ecosystem. That, along with the fact that the Prime Minister has this absolutely crystal clear vision that in the semiconductor space too, as part of broadening and deepening our electronics ecosystem, as well as looking at the geopolitical opportunity for building in India one of the large fabs in Asia that will be non-proximal to China, is yet another opportunity. And again, around the semiconductor space, given the nature of Moore's law and given where semiconductor industry and innovation is headed, it is playing to India's strengths, where the future of semiconductor innovation will be driven in large part by design innovation, and system design, rather than the only relying on the power of the fab and power of manufacturing and the power of chemistry and physics, as was the case as Moore's law predicted for and has held good for over 3 decades. So in a lot of ways, this new digital the gold rush to digitizing enterprises, mini enterprises, economies, governments, and consumers is placing India at a very sweet spot in terms of the opportunities it represents for India, its businesses, and its entrepreneurship. And coincidentally, it's like the perfect storm in reverse for India, where the entrepreneurship and startup ecosystem has really reached a critical mass in terms of how it is contributing to the Indian economy and what a dynamic presence it has made for itself. So as the opportunities in the innovation ecosystem and the digital ecosystem expand, as is the case, this startup and innovation ecosystem is poised to capitalize significantly on it. I can go on and on about this, and I know it's a seminar and it's a summit, and I don't necessarily want to grab all of the time from all the important discussions that will be held. But as somebody who has been an entrepreneur in India for several decades, and then moved to public life and public service 15 years ago, I can say as an individual and as somebody who's a citizen deeply invested in this India story, that the leadership of Prime Minister Narendra Modi and the direction and vision that he has set out for the last 7 years is really coming to making India today be at this tremendous inflection point as the world around India has changed and presented in a lot of ways to India and our economy opportunities that are unprecedented and never before in the history of India as an independent country. So I am deeply confident about what the future holds for India. I'm deeply confident about the Prime Minister's Atmanirbhar Bharat, the vision, and how that is going to allow the entrepreneurs and startups and businesses of India to be viable, sustainable, and competitive in this new global order post-COVID. Thank you all for the patient listen. I wish you all the very best, and I wish you good health, and I wish, since most of you are investors, I wish you very, very successful investing in the coming years. And I hope you're all very long on India, because that's the new normal for investing around India. Thank you. Jai Hind.
He has a very busy day ahead. We thank him for making time for this address. As the Honorable Minister just said, that we are now the fastest rebounding economy in the world. Wow, that's news and music to my ears. He also spoke about how we may have missed the mark in 2020, but as an economy, we will make target in the years ahead as a $5 trillion economy. That's also music to my ears. Thank you very much, Honorable Minister, once again. Ladies and gentlemen, before we move on to the next session, here is an interesting factoid for you. The big picture, learnings from the pandemic and roadmap for a $5 trillion economy. Pandemic and a roadmap for a $5 trillion economy. Ladies and gentlemen, COVID-19 can be best described as a black swan event. 2 years down the road, the country mercifully has seen a slow but steady recovery from the harsh impact of the pandemic of the century. The pandemic challenged everything and changed everything, and so many a lesson was learned. In the first panel of the day, we shall underline what we learned and what we unlearned. The panel will also discuss the major trends that have emerged from the pandemic and the enablers needed today to bring the economy back on track to reach the $5 trillion ambition by 2024. I remember reading about the Economic Survey 2019 presented by the then Chief Economic Advisor, Mr. Krishnamurthy Subramanian, that focused on moving to a virtuous cycle of savings, investments, and exports to transform India into a 5 trillion economy in the next 5 years, he'd said then. Well, I'm not the expert here. Let me invite on stage the tiger minds of India. The speakers of this session, ladies and gentlemen, Swaroop Mohanty, Director and CEO, Mirai Asset Investment Managers, India. Good afternoon, sir. Very warm welcome. Are you, please? Ritu Arora, CEO and CIO, Asia Alliance Investment Management, Singapore. Good afternoon and a very warm welcome to you. Dr. Niranjan Hiranandani, Managing Director, Hiranandani Group. Namaste, sir. Good afternoon. A very warm welcome to you too. Prabhat Avasti, Managing Director and Country Head, India, Nomura. Sir, good afternoon and a very warm welcome to you. Ashwini Kumar Tiwari, Managing Director, IB/TNS State Bank of India. Ladies and gentlemen, sir, good afternoon and a very warm welcome to you. And of course, I'd also like to invite on stage the moderator of this session, our very own Sutajit KK here on SK, Editor-in-Chief, Mint. SK, over to you.
Hello, everyone. We have a very, very qualified panel here this afternoon to discuss about the topic for the very first panel of day one. Today we'll be discussing the key takeaways from the pandemic as well as the roadmap to the $5 trillion economy. I don't think there has been a theme that we have all mulled about and heard about more than the pandemic. And I really look forward this afternoon to hearing from this very esteemed panel their thoughts on the same. The way we will structure it is that first I'm going to ask the panelists about what have been their key takeaways in their respective domains, in their companies, in the very substantial companies they lead, as well as the economy, because they're all also very astute observers of the economy. Then we will go on to the second part, where we will discuss the opportunities in our journey. What are the things that will work in India's favor as it aims to become a $5 trillion economy from a 3.1 odd trillion economy now, and what are the challenges that we need to watch out for. Without further ado, we'll start. Maybe we'll start from the other end. Why don't you, Prabhat, tell us about... I'm so sorry, my apologies. Swaroop, why don't you tell us about your key takeaways from the pandemic?
Yeah, thank you. Thank you so much for having me on this esteemed panel. Thank you, Mint, for getting us back to the live world again. Big kick to be sitting in a forum like this. But when you look at 2 years and we are talking about a virus running the world and we're shutting down ourselves in a house, it's more like a science fiction movie than anything else. And when that happens, the impacts will be dramatic. It's a foregone conclusion that the chief technology officer of the world is now COVID-19. And that's been what unfolded practically on all of us. From a mutual fund perspective, and I'd like just to make 2 quick points. One is, when you look at the heart of our business is dealing. That is the buying and selling of shares or securities as we call it. What was very significant, and this is something which has come down to me all my life, that is the sacred part of your business. And you're actually not allowed to enter that place because that's where everything happens. What was so significant to watch was that this sacred part of our business was allowed to go home. And allowed to go home with the nod of the regulator. Just reflected 2 things. One was the fleet-footness of the regulators in India. They rose to the entire challenge to the whole thing. And after COVID, there have been audits. just shows that the integrity of the people involved in this business was high enough to conduct this so-called sacred part of the business from their houses, which to me has been the number one significant impact. And when you look at it, if dealing can go home, that means everything can go home. The entire business of asset management stands disrupted as we speak. The other part is, when you look at shutting all of us down at home and as now looking at our income expense statement, is this dramatic shift to financial assets. When you are in a near-death sort of situation, there is a flight to safety. And I think COVID is that trigger which now starts an incredible journey of financial assets over physical assets for whatever reasons of the past. There was a before Christ and after Christ, and we feel for our industry there is before COVID and after COVID. That's how it will play out now.
Swaroop, you spoke about the sanctity of the dealing room. Could you give us a flavor of what happened in terms of technology? What kind of technological fixes or solutions you had to very quickly deploy to preserve that sanctity?
Honestly, I thought I was a little ahead of the technology gap. Within the first week, I realized I knew nothing. From the basic VPN that was required to take this machine home to the internet speed. And let's face it, the entire country shifted to the internet. And to be fair to the internet providers, they did also rise to the occasion. So it's not just us. I'm talking about the entire environment coming together to take this, speed of business from home. And that was significant for me to watch.
Sir.
Thank you. May I request the audience for a big round of applause? थोड़ा हल्की हल्की ताली लग रही थी, if you can, please. Thank you very much. This we will never get in a virtual world. So for the last 2 years, we have been small icons on the screens, most of the time video off. That's how all of us have been working. So video on again becomes a little bit of a discomfort. And that's why when we actually sit in person, we have these issues like, ye naam kahan chala gaya, wo kudhar ho gaya, and all of that stuff. So in that sense, it'll take some getting used to even come back to the physical world, which hopefully we will continue. But to me, the takeaways from the pandemic, the first takeaway is, and we have to be mindful of the fact, the last such event happened in 1918, the Spanish flu, unfairly called Spanish flu because it was detected in Spain first, though it originated in maybe a different place. That killed, by various estimates, about 50 million people. We are today around 6 million and counting, or maybe 8 million, whatever the latest number is. And this was so traumatic coming after World War I that there is so little reference in history to it. And we had to read through various books, and most of the new books are recent. In India, 5 million people apparently died from that pandemic. Not a single reference in any history book. I don't remember, at least I never read anything, and I've read history till class 10th. I don't know if any of you have read in history, even if you've done a graduation history, if this pandemic is mentioned anywhere, the 1918 Spanish flu, only because it was so traumatic. However, so therefore that reflects upon the fragility of the human race, and yet at the same time, what we have also seen is the resilience of the human race. We saw it also in 1918, the roaring 20s which followed, which of course were an interlude between the world wars, but there was a superb growth in economy, in entertainment, in all kinds of arts, fantastic period, the 20s, coming right after the pandemic. And now this roaring 20s, hopefully, again, we may have, it's not started well this year, but hopefully we'll quickly overcome this. So the resilience of the race, the vaccine got developed in 4 months flat. I mean, can we beat it? The last time the record was 6 years, I believe. So 6 years compressed to 4 months, just unbelievable. All the testing got compressed. So that leads to the resilience part, and this reflects across. He talked about the working from home, shifting the dealing room to home. Even in our bank, and I was in New York when this started out, and we had no clue how to take our core banking system home, never done that. And then we had to quickly, in a month's time, figure out the VPN system as it prevails, our data centers in India, by the way, and how the network will operate, what will be the security patches or the programs which will be required. And then, of course, treasury dealing is a part of it, so Bloomberg feed at home, all of that got figured out in 1 month flat. We were working from home. So this shows that how quickly we can adapt. And then, of course, one thing which is not given enough credit, and there's nobody representing telecom here, is the nuts and bolts of internet, the telecom, the various providers, how this held up. The volumes which went up by 5, 6 times, or maybe more, 50 times, still it held up. So that's the other takeaway, that this flexibility and agility which we have now shown as a human race, even as in the working, this will continue, in my view, that's my hope. And we will have more innovation on this front as we go forward. So therefore, this resilience which has been shown, we will need it more and more. Ukraine is just a small blip. We are going to have more black swans in the climate change, which is going to hit us as we go forward. So we better be prepared for this as we go forward. Thank you.
Mr. Tiwari, you're the only person on this panel who actually has a retail banking business, and that is one thing you can't really take home. Bank branches have to be opened. SBI, of course, plays a very critical role in financial inclusion. Could you give us a flavor of what were the challenges involved when you discussed how do we navigate this? How do we keep some of the branches open and yet our employees safe?
So I have to salute all our branch staff and people. All the branches were open all the time. Not a single branch got closed, unless the government of the area closed it. We have lost 825 colleagues in this pandemic. And my salute to all the families and all the people who lost their lives trying to serve the people at large. Not only this, we have supported the vaccination program when it got rolled out. So not only did we get our staff and their families vaccinated, we also helped the entire ecosystem around us, the vendors, the partners, all of them and their families also to get vaccinated. And of course, we did develop the work from home, but as you rightly point out, it was a requirement by the government. And a physical presence was a must, especially in these times when the access, the movement, and all of these things could also be affected, the cash movement around the country from various chess branches, from RBI to the branches. All of these had their challenges from time to time. But we managed, the branches, the clusters, the states, all of them collaborated with each other, and it was such a fantastic collaboration with the government, with the NGOs, with the hospital authorities. We developed our own in-house, I wouldn't say hospitals, but places where people could isolate and they had oxygen available, etc. So a lot of stuff went on, and the best part is banking is a very process-driven industry. It is very highly regulated industry. So RBI was also very agile, like the SEBI and other regulators, and they kept on changing regulations to enable the branches and the banks to function and to continue to serve the customers. And similarly, we also changed our processes where required in a very agile manner. We delegated a lot of authority to the regional managers, who are the people on the ground in the respective districts, to actually work as they deem fit, wherever, whichever people, how many number of people are needed from one place to the other. All of that we delegated. We did not actually lay down any of the broader policies which we very rigorously enforce in other times. And of course, the various schemes of the government, like the emergency credit line and so on and so forth, the moratorium which came in, these came in so thick and fast. I mean, there was a time when we were finding it difficult to react to it. But I think all of that really helped in stemming the sudden loss of momentum, the sudden stoppage of the economy, and it helped that it doesn't fall under. Otherwise, there was a risk of the whole economy falling across the cliff. So I think it was a really marvelous piece of work which done by the banks and various other players, including the staff of the banks. And I think there is time to actually look at this in perspective and see what learnings we have learned from this and how can we use those to make the system better and more resilient.
Our sympathies to your colleagues who lost their lives during this time. And I want to come back to and listen more about SBI, because it's utterly fascinating how such a vast operation navigated through the pandemic. But Prabhat, let me come to you for now, and could we get your opening thoughts?
So I think a few things, and obviously the resilience has been talked about, and I think that's true for every organization, because it was absolutely important to be, flexible and resilient to sort of survive this. And we are a global company. We have multi-country operations, and when we had COVID raging in India, it was quite fine in, for example, Singapore, and the situation is different now. I think it was important to be actually flexible in terms of how you operate. And as Mr. Tiwari said, giving flexibility to each office, depending on the situation, was absolutely crucial. So I think decentralizing decision-making was very, very critical. But what was very interesting was that if you really look at last 2 years, right, stock markets new high, volumes in stock markets at new highs. We had record FDI in this period. You're talking of high involvement investment decisions being made all online. You would have not thought this possible if you had, on the other side of pandemic that, you get $60 billion FDI plus. So I guess technology itself, and I shudder to think what would have happened if he had this kind of problem 10 years ago. I mean, thankfully we have, high quality internet now. So I think in that sense, being at the stage of technology that we were actually really helped in getting to that side. I think the other thing that I sort of find quite interesting is that a change in mindset. I mean, pre-pandemic, you would probably have people 9 to 7 working in office. I mean, today people, we really don't have an insistence on where you work from. So even though we have opened our offices, nobody's checking. The fact is we've realized that work goes on, people are responsible, and in fact, flexible working environment has very much become part of sort of a style of working. So there are people, so if you've got meetings, people will come to office, but not necessarily when they don't have. For example, in our company, we are sort of saying that for corporate functions, we are happy to have only 50% people working from office going forward. So this whole change in mentality of 9 to 5 office and everybody has to be in office for office to be running, I think is probably a long-term change. How it sort of impacts our lives, etc., we'll have to see. And the last thing I would say is, even though we learn to live, remotely, but I think need for interaction in office is also very important. I think both from mental health perspective of people, also in terms of bouncing ideas around. So I think it's important that we also found that once you open the office, there's a lot of keenness to come back, not necessarily every day, but I think it really helps, as Mr. Tiwari said, to sort of be there in office just in order to sort of, for the organization to remain relevant in terms of ideas. And it's very difficult to, I think, ideate and collaborate when you're sitting separately. So I think that was the other sort of, takeaway from my perspective.
This, of course, is in some ways the debate of our age, whether working from home can be as effective as working from office. Where do you find yourself on that debate? Do you find that you can really effectively work from home, or you do need some interaction at work among colleagues?
So I think it'll be a hybrid as we go forward, right? So the fact is that if people in office don't meet, for example, and I'll take an example, investment banking team, they don't meet once in a while, they'll not know what is happening in each other's domain. So you just always cannot do it sitting separately. Bouncing ideas around in terms of what you're thinking about markets, I think that is not possible if you're sort of sitting separately. However, day-to-day business is quite possible. So I think it'll be a hybrid. For certain functions which are rote, for example, pure corporate functions, it's quite possible that you can continue to do this completely offline.
Oh, sorry, Prabhat. My interest is in finding out which camp are you in.
So I'm not in, as I said, I think both are necessary. You cannot completely divorce office, but you can give a lot more flexibility today in terms of how you look at people not coming to office all the time. I mean, that's how it'll be.
Tell us one slightly insidery thing, but tell us a little bit about, so just for quick context, so the Nomura Index of Economic Activity became one of the most tracked indices during this period. All of us journalists love using it. The Google Mobility Index and the data team at Mint, they basically, this is, a big part of their toolkit. How did it come about? Is it something that you used internally and decided then to publish, or?
No, I think all credit to our economics team. Sonal, she has been a very well-known economist for a very long time. And she is, very quick in terms of figuring out what is needed at the point. So I think it was entirely done by the economics team. But there was obviously demand for figuring out one tool which can give you because we're all struggling to figure out, what is actually happening. How do you encapsulate it in one single sort of measure? And I think, well, one we were quick, I think, and the fact is that given that we have credibility in this space, it got adopted. So I think it was partly timing, partly I think how we responded to the whole demand. But once it sort of takes hold, obviously it becomes obviously becomes the most quoted index. So yeah.
Very, very influential index indeed. Mr. Hiranandani, you are another person on this panel for whom, I mean, you're the face of an industry that just couldn't, go home and work. Very, very large employer across the country. It impacts both your operations as well as demand, which obviously impacts all of your future plans. What have been I mean, you've of course very successfully navigated this period, but what have been the big takeaways?
I think the idea that we're able to manage situations which were considered impossible, I think the flexibility that we talked about, I think is unimaginable. Whether it's in the real estate space, whether it's in the commercial space, whether it's in terms of social delivery space. I also run a large education space. All that put together, we found that we were able to get back to action very fast. And I think that's a big learning that we found. Of course, technology helped us, but I think people were able to adapt much faster than I thought they would. Be able to continue to deliver, which is again something very difficult to achieve in terms of large numbers. I think we were able to do that. The residential space actually benefited hugely. I don't think the papers have covered it adequately enough, but we benefited a lot. Husband working, wife working, 2 children studying from home, all locked up into a house. The importance of the house was you don't need that much space. They all go to office, go to work, or go on a holiday, or study from. But everyone in the house locked up for so long, there was a huge upgrade in people who could afford the house to be there. So 25% of my sales of the upper segment was actually upgrade of houses in a short period of time, especially those which were ready. And fortunately, the persons who were selling also were able to sell. So in reality, real estate kicked off even better in terms of residential segment. As far as the commercial real estate segment, obviously people working from home, there was a setback in the whole thing, and hence a consolidation has taken place. So you won't find now smaller players working in the commercial space as they were wont to do earlier, because you actually rent out commercial space when it's ready. So it's a longer investment space, while in a residential space, you can invest and start selling spaces. So huge consolidation in commercial as compared to residential. That has definitely happened and will continue to do so for some period of time. Working from home vis-a-vis working from the office, my gut feel reading, we've tried to do numbers that we are talking about. We think about 20% at the most will work from home. 75% will still do it, but there will be spaces where it will be the reverse. So there may be, let's say, banking space or IT space where this could be a reverse action to take place. But if economy grows at the pace of 8% or double digit after the war and this whole thing is corrected, the requirements of commercial space will again come up and the supply will become grossly inadequate. So commercial space is also going to grow over a period of years. And I think both the things, and if you're looking at the $5 trillion economy, the requirement of commercial space is grossly inadequate as compared to the supply that is coming into the market. So people are insecure because you need larger amount of capital to put into commercial real estate, and there are not enough smaller players which were there originally and are really moving out of the commercial space completely. So I think that's a big change. On the education side, which I play a role, we have 45,000 students in colleges. In the next 3 years, we will have 450,000 students online at least. At least, I said. So you're going to see a difference in it. Education will now continue lifelong. This was never there. People finished from college, they finished from management school, they went over there. I think learning will start after you leave college. So you're going to be able to study now lifelong, whether you're 30 or you're 40, you're 50 or you're 60, you will have to learn because things are changing so fast in the learning space that I think earlier I'm a chartered accountant by qualification. It took me 20 years to become out of date when I passed my chartered accountancy. Today, I think in 5 years, you're obsolete. And unless you're not constantly being educated, re-educated, unlearn whatever you want to do, especially on the fields of things like banking and others, the kind of technology changes and the transactions taking place without anything, e-commerce also being whatever. Yesterday, I went to buy something at Decathlon, physical. I went there because I wanted to buy some things, and I just walked over there, and I picked up 5 items. And there was a queue of 30 people there. And they said, I said, I can't wait for 30 people half an hour to actually pay my bill. So they said, you know what you do? You download the app, you can put it all over there, and we can just do only the swipe of the card on the counter. But if you have to stand in the queue within the physical part of it, it'll take you half an hour to pay your bill. I mean, I was amazed myself, though I understand what was happening. But can you imagine something in a physical space also upgraded the technology to such an extent that they said, please down. So I downloaded the app, did whatever it is, they did the site, and within 3 minutes, I was out of Decathlon, which would have taken 30 minutes. So even the physical spaces, because of technology, is completely changing in the next couple of years. Unimaginable to me, if I was day before yesterday in this lecture, I wouldn't have been able to understand that this is possible. You know, these are the kind of rapid changes. Real estate space demand of the quality space is increasing further, and the locations are going to change completely. So you'll want a holistic environment where health is important, education is important for children, the kind of quality of life people want to lead, but new spaces will come up in the peripheral areas of cities or in second-tier cities, and I think that is going to grow exponentially. Hasn't happened yet, but I think holistic townships on the periphery of areas of major cities or things like that are definitely going to come and grow. You'll see a lot of new things happening in the next couple of years. I feel and predict to be the kind of direction which has not happened till today. People don't want to stay too far and all that, but now I think people don't mind staying far away and being able to work over there, and especially if there's a, as you said, not have to come every day to work. I think that part of it is there. So COVID, pre-COVID, post-COVID, huge changes both in terms of the way business is going to be handled, technology is going to make a difference, and how this thing. I'll give you an example. I was talking to somebody of the next generation. We don't watch TV. How can you not watch TV? I mean, you must be, no, they're on the net. So they don't watch TV at all.
Well, they probably watch Netflix.
Internet, yeah, Netflix, yes, but they don't count that as TV. You know, it's an internet thing because they can see it on their computer and stuff like that. So they don't even watch it on TV, they watch it on the so it's an internet connection.
I highly recommend it, by the way.
Yeah, I'm not, no, I'm just saying that the changes taking place in person of my generation, I would flip on the thing, see the latest news on TV. But my son and the next generation will not. I'm just trying to say the changes taking place are so drastic in terms of the way people deal with things is going to completely change in the next couple of years. And in every field that we are looking at it, this thing, the exponential to technology in terms of data which is collected is not 5 times, it's 500 times. So, and with 5G coming in, it'll be 5,000 times. So I can't imagine how this change is going to be actually taken care of. But it's happening, and it's not happening. It's happening within the next 2 years. It's not happening in the next 5 years. So technology change is causing a change in our way of living and life, is taking place much more rapidly than we have imagined. But you can have an Ukraine and Russia war, and then there is going to be another change as to what we're going to do, and I don't know how that effect will be there. I think my other people would be better on my panel to tell us what that effect would be and all that.
I want to hear more about the 75-25 split you talked about, but let me first go to Ritu, who now has the unenviable task of coming up with ideas that have not already been taken by the others. Resilience, flexibility, all of them gone. Ritu, what have been your top takeaways?
Yeah, not to mean speaking after 4 eminent speakers, but let me speak about my industry, which is insurance. Allianz is the global major in insurance, the second largest insurance company globally, with 70 country presence. I give that context because what I say will connect to that. So 70 country, 150,000 people. And as you will all know, the mainstay of insurance is diversification, large pool and diversification. So first time in our living history, we had a situation where all our 70 countries and all our operations were hit by the same challenge. So that's the best way to test the resilience of an insurance company. It was a challenge of mammoth proportions. But also in that challenge was an opportunity of mammoth proportions, because this was absolute realization by everyone that risk is real and risk needs to be covered. Risk was at every doorstep. So it was a very unique situation that we were presented with, where our P&Ls, our balance sheet, our deliverables, our customer service, everything was stressed to the hilt. At the same time, it was an opportunity where first time insurance was seeing a pull rather than a push. So very interesting for us. And in the midst of all this, we saw a complete reset of how talent was being engaged, and we believe it is a way talent will be engaged even going forward. And here I don't talk about hybrid work from home or hybrid work arrangement. We saw a big dearth of skills. We saw a difference in the way skilled force talent was being categorized. It was no more on number of years of experience, gender, qualifications. It started getting very skill-based, which is a significant shift in the way people were looking at it. Geographies did not matter anymore. And more interestingly for me, off-balance sheet talent started becoming a significant part of our deliverables. I believe these are trends that will crystallize even further going, probably pandemic was a catalyst, it was waiting to happen, but that brought the urgency to the table. And these are trends on workforce talent management, which I think are going to be very significant. We are, of course, customer-facing. So we saw, again, a very significant change, which was what the customers are demanding from us. So there are four kind of words that summarize it: convenience, ease, connectivity, and seamless experience. And that, again, I don't talk about shopping online or e-commerce. Of course, we witness a sea change there, where even my grandmother now orders vegetables online. That is, of course, a change.
Do you want to tell us which particular app she uses?
I take money for that. But besides that, I see a significant change coming in health. The whole entire health journey is soon going to be digital, seamless, and available on your phones. Telemedicine is going to explode like never seen before. Education, though it doesn't really impact insurance, is going to change. One great professor need not teach a class of 45 anymore. He can teach 450 people. He can teach 4,500 people at the same time. So education, I believe, is going to see a significant change, especially specialized education. So that's another trend that we are witnessing. And lastly, I'd like to mention climate. I think we as Allianz are very passionate, but in these last 2 years, I think the realization around climate being a real risk has also become very, very pervasive. I think the risk has been recognized across. And now it's catching the momentum, which I think will be a force to reckon with. So those are the trends I notice.
Thank you, Ritu. One follow-up question. As an organization, did you pivot a little, somewhat or quite substantially towards digital channels of sales, or you were already there?
We were there, but it was not a pull. And it changed significantly. So we were all prepared and were there, but it was, even to get, I'm sure many of you would have faced, the agents would need to call you to ask for your mobile numbers to be updated, emails to be updated. That changed it drastically, because then the customers were reaching us to say, can you please update, because they knew any fine day in middle of the night, they're going to need to utilize their product, and it better be updated. So it put a huge, huge pressure on our customer service, on our portals, on our digital footprint across. That's a very welcome change, but that's also a big opportunity. Now we have a digital connect with all our customers. It's a marketing person's delight.
And also, I think insurance as a category, right? I mean, it really, pandemic really drove home the uncertainty of life, and therefore, the point of needing insurance, especially in a country like India, I think that has been driven really home. Did you get any help that way from the pandemic as a category boost?
Yes, we did. We did get that. In fact, for us, general insurance is as important. And with the supply chains breaking globally, that also became a very significant part of the challenges businesses were facing. It was not just health. But yes, health insurance, as we all know, and life insurance, as we all know, saw a big spurt in demand.
Thank you. We heard so far from the panel mostly things to do with their organizations and their industry, which is how they saw the pandemic play out, what have been the significant takeaways. And we'll pivot now a little bit to talk a little bit more about the economy, the $5 trillion roadmap. This was an ambition that was articulated a while back, by our leaders. And I think it's been clear for a while now, and since the pandemic hit, that the idea of $5 trillion economy by 2025 is in all likelihood not going to happen. And therefore, it has opened up questions of, okay, and then now what then? Where will we get there in another 2 years after 2025 or before? And to my mind, those are actually less important questions. The point is that the economy will change in substantial ways. The pandemic has really, it dealt a pretty severe blow to the economy, and there is now a lot of focus on the shape of the recovery and so on and so forth. But I think it's important to imagine what will be the significant shifts that we will see as the economy grows further and nearly doubles from this point onwards. Swaroop, let me come to you first, and we won't necessarily stick to this order in this round so that Ritu doesn't have to wait again all the way till the end. But top two opportunities that you see in India's favor, the tailwinds that will get us to the $5 trillion milestone.
Yeah, I think we come from the personal finance side, and I think significantly what changed for India was in 2018, as you rightly mentioned, when the finance minister sat up and put a goal to the country that here we are going to go to 5 trillion. And when you put a goal, everything changes. Then the measurement of the country changes. The fact that we are sitting here discussing whether we are on track or not is because of that goal, right? So when you look at the breakup of that 5 trillion, typically it was 1 trillion from agriculture, 1 trillion from manufacturing, and 3 trillion from services. Services would be our side. And that's pretty significant. And you have to keep in mind that as India grows per year, the demography of the country is also changing very fast. Bulk of that services is consumption. And post, COVID, the way things will be consumed is totally different from the way the things were consumed of the past. Add to the fact what Mr. Hiranandani was reflecting, the young today consume very differently. They are moving from asset consumption to experience consumption. And here's where India now comes in pretty dramatically. If you go to, say, pre-COVID, it's a reality that India had sort of tapered down a bit on growth, but everything is advantage India post post-COVID, and we are kind of back from a comparison, and everything is relative comparison from the EM perspective. And then when you realize that you are back, you have to seize the opportunity. And then when you look at the basic framework that we've done, we've broadly identified that there are 12 industry parts which we'll focus on. And if we can now move to specific you can say, reforms to these 12 industries that we are focusing on, a lot can happen. We are back in the business, as we say. But, you know, from broad, the economy perspective, our house view is, you know, just look at some of the tailwinds that will impact us because of the impending war. One that is over, we can be back on track. But for me, I think a lot can be discussed on the policies, but it has to be business-like from here. If you have to sit down and say, hey, we have to reach 5 trillion in X, please remember that the 5 trillion that we started off in 2018 is not 5 trillion anymore because it's 10% more because of the rupee.
Important personal finance lesson.
Yeah. So then if you are deviating by 2 years, then hell should break loose to ensure that we be there in 2 years. Rest can all fall into place. But this is business. I was very happy to hear the minister saying that we will not deviate from here. And that is more important to me than policy making or anything, that we are very sure that we'll do it on that particular day. Then everything falls into place. All of us will align to that. That's a reality.
Very interesting. Mr. Tiwari, do you agree with this assessment? Do you see that there is that kind of sense of mission and all components are aligned for this kind of a goal?
Yeah, so any number does focus minds onto it, and therefore one starts to feel about how to achieve this. Just to put things in context, 5 trillion given in 2020 or 2018, assumed exchange rate constant of 73 rupees to a dollar, which is now close touching 77, 76.8 or 7 today. And a nominal GDP growth of 14.4%, which we know how it has trended since then. So therefore, this number definitely is going to go beyond 2025, whether by 2 years, 3 years, 4 years, we can recalculate. But as you say, what are the opportunities and what are the challenges? One opportunity which India has always had, and we don't talk about it too often in the last 1 or 2 years, largely because of COVID, I think, is the demographic dividend, which is again a challenge as well. So we have the youngest population amongst a lot of countries of our size. There are countries which are younger than us, for example, Afghanistan, but we don't compare ourselves with that category. And this younger population, which if educated well, and which finds jobs, will consume more and more. And as consumption goes up, the GDP automatically goes up. So that's the biggest opportunity we have. But the challenge is, how do we educate them well? How do we give them the skills and then the jobs? No point in having such a large population and which is not optimally educated or does not have the jobs which satisfy them. People who do a plain class 12th or a graduation from a subpar college end up as a security guard in a residential colony is not something they're looking forward to. Such a lot of people would be not very happy, and when you have a lot of people who are resentful, that's not a good thing for the social modes of the country and the social health of the country. Then they get diverted into different directions. So therefore, the quality of the education, and we have to remember we have lost 2 years, even if online has done well, online education, but no substitute for physical learning, especially in the younger children. So how do we bring all those younger children cohort back to where they were? We have promoted many of them without exams, but does that take them to that level which they were, or what is the gap which needs to be fulfilled there? All of these are decisions and things which we need to do very quickly. On the other hand, as a couple of speakers pointed out, there is a lot of shortage of skills as well. So how do we bridge this gap that on the one hand, we have lots and lots of people without good quality jobs. On the other side, we have a shortage of skills. And then that flows into the next opportunity. Assuming this is solved, it leads to the next opportunity, which is that the services piece. You talked about services. 55% of the GDP is already services. But more than that, India has done really, really well in services. So we talk about IT all the time, and believe me, in IT, anybody with a little bit of experience today is commanding the salary in the market. And we are a bank, but all our vendors, and these include the biggest names in the industry, they're finding it so challenging to retain people and to hire fresh or experienced people. So therefore, that's just one leg. But you talk about telemedicine, that's coming up very well. It's starting to do very, very well. Legal tech, looking through documentation, scanning that, preparing briefs. So there are so many varieties of services, outsourcing services, and so on and so forth, consulting, which can be done from India. One doesn't need to go to a particular country, because today the climate is such that most countries do not want people to come there. The sentiment is against migration. So therefore, it might be a visit for some time and then going back. The base has to be in India. And that is good for us because that helps our economy as well. If the person migrates ultimately, then they consume there, all the growth is into that economy. So in that sense, if you are able to get that salary or 75%, 80% with that salary, it helps everybody. So I think this is the future. We must focus on this, resolve all the issues around data privacy, protection, IP, all of that. There are some elements there. And then I'm sure this is the biggest opportunity we will have, and this can really employ a lot of our people with decent English skills, with basic education. We will do very, very well there. Just we need to really focus on that, because manufacturing is tough. I mean, nothing against manufacturing. Low-cost manufacturing, especially in textiles, especially in areas, I mean, even tourism for that matter, in services, all of those are areas which employ a lot of people, and we need to focus on those. But getting land in India is tough. Getting land at a reasonable cost is tougher. And similarly, aligning all the issues around movement of labor, getting those requisite skill sets is tough. So while we continue to focus on this, let's take these low-hanging fruits and let us focus on this. I think that's a big opportunity.
Very quickly, private investment is a big factor if this were to happen. I mean, if you have to get anywhere at all. From your interactions with the industry and others, I mean, do you think there is a conducive environment, both from a policy perspective as well as sentiment perspective, that will spur private investment?
So the recent past has been really good. Of course, the COVID was very uncertain, so people had put all their investment plans on hold, except for the real estate industry, which was doing really well. The capacity utilization, especially in the core industries, has still not reached 100%, still around 70-odd%. So therefore, fresh investment has not started. It has started in few areas, but plans are there, sanctions are in place, but the actual implementation is still starting out. Areas like renewables and roads and all, they continue. But the core industry, steel, for example, totally deleveraged. They had a good cycle going and they really made use of it. So the government's efforts in terms of two things. One is the PLI scheme, which as a group is very good. You can argue about the need or the pluses and minuses and whether it should be stretched economy-wise. But I think it helps to focus on certain high-tech industries, especially where we see the strategic element going. Now, if 90% of the high-end chips come from Taiwan, and if all the solar panel inputs come from China, the APIs, the molecules all come from, for the pharma come from China, I think that's something we need to focus on as in a strategic sense. So that's one part, which will actually trigger the investment into these high-tech industries. And we have seen very good results in all of those areas. Some are still coming up. That's one side. The other is this public digital infrastructure. Now, we've talked a lot about UPI, which has been a fantastic journey so far. But the next two phases of, if you will, the UPI 2.0, for example, the feature phone, not the smartphone, which is about, feature phones about 30-40% of the population. Unless we solve for those, financial inclusion through UPI may not have happened. And the second is the account aggregator framework along with the OCEN. Because unless you are able to give loans on the fly to merchants, we know a lot of work has been done on this in platforms and all that. But the public infra is the key. Because otherwise what's happening today is while the big tech platforms are enabling some of this to happen, but the data stays within those networks. It's not public. So through the account aggregator framework, and my hope is that at some point, if the big tech is going to provide all these platforms where a lot of merchants reside and a lot of consumers reside, that database should also be part of the account aggregator framework rather than only the banks and the financial industry. So,
can you give us a flavor of how the account aggregator system is shaping up?
It's early days.
Right.
So what has happened is everything is in place. The account aggregator licenses, about 4 or 5 are in place. Lot of users are there, but providers are, not everybody is providing in the same thing because they first have to, every provider is potential user as well. So therefore, all the bigger banks, including ourselves, while we have signed up, but we are still designing those products so that we can offer these loan products and various other products on the instantly. And once we are able to do that, then of course we will provide, we will use both. Because it can't be one way. If we just provide, then that's very unfair when we open the account, when we have done the KYC and all of that.
Yeah.
But I think in the overall run or longer run, I think it will be good for the industry, it will be good for everyone, and most importantly for the customer.
Got it. Ritu, let me come to you now. One challenge and one opportunity on India's roadmap to $5 trillion.
Like every journey, I think it's not the destination one should set the eyes on, but the entire journey. And I think we already embarked on that journey. And it's a quite a fascinating journey that we are on. I mean, just to put it in context, by 2030, we would be the third largest economy, dislodging Japan and Germany. So we're already getting there. And obviously, what will happen is already happening is with it is discretionary consumption exploding. It's also very good news for market participants like us, because this is obviously, if economy goes to 5 trillion, there's a huge amount of wealth to be made. There, the opportunity is to harness the capital from within the country. And harnessing it, I mean, it works well for equity markets now, but it still does not for AIFs, REITs. I mean, there's a huge part of the economy that needs capital. And to be able to energize and to get domestic capital into these sectors, I think will be hugely reinforcing. So that's an opportunity that we should be able to harness. Of course, the journey gets faster and quicker if we do that. The challenge, I think, would be unequal. This growth and this journey to 5 trillion is not carrying everyone with them. There's a wide disparity, and inequality leads to social challenges, especially when wealth is being created in some pockets. And hence, it is important that we find frameworks, support systems, that help carry SMEs and other sections of the society with it as we make this journey to 5 trillion. So that's for me the opportunity and the challenge.
Well, the time has flown past, unfortunately. But so very quickly, Prabhat, I want to get your comments first, and for wise words from Hiranandani will be the last. So your thoughts first, please.
So I think in terms of opportunities, I think a lot have been spoken about. I think globally what's changing is that I think India has, people are trying to diversify their manufacturing destination. I think this is a very big opportunity which we did not capitalize on last time when sanctions on China came up. And I think it's really critical because while services may drive the economy, the fact of the matter is, we probably at some point in time will start importing more, mobile phones than we import oil. And we really need to manufacture what we're going to consume because our current account deficit is running very high, and our ability to sort of even take higher oil prices has declined considerably over a period of time. So I think it's really important for India to diversify into manufacturing areas where the consumption is rising very rapidly. I think it's really critical because otherwise we'll not have resources to invest. I think it's an opportunity as well as a challenge. And I think in terms of challenge, I think finding right people will be really critical. I mean, we talked about, for example, elections which happened. Unemployment was a big problem, right? A big election topic. And here we are talking about not finding people in our companies because, even if you're paying, we're seeing churn go up. So the problem is that education, higher quality education, I think is an issue because you're talking about, engineers who are coming out might not be of the top-notch quality that you require. So I think while our services economy has grown, our education quality on the whole, the kind of quality that is needed is not happening. And it's really, really a problem that as we go forward, I think it'll really be constraining.
Thank you, Mr. Hiranandani.
$5 trillion economy, you cannot achieve without a 10% plus GDP growth. So I think you'll have to watch the war, you'll have to watch the prices of oil, and both these things will really be something which you have to watch in order to get it. I think the banker has clearly told you that in India, the problem is when you set up 5 things, you're not getting land. Where you get land, you don't get approvals. Where you don't get approvals, you don't get skill sets. And so 23 textile companies, majors, which moved out of China, only one came to India. Bangladesh GDP per capita has grown more than India. So you're going to get reverse migration of people going from Bengal back to Bangladesh. So the opportunity is huge. We really can achieve it. There is no problem about it. The demographic dividends we talked about and the others is definitely there. You forget the skill set at the level at which Ritu is talking about or the banker is talking about. I don't get plumbers, electricians, painters, carpenters. We don't have those skill sets. And on the other hand, we have millions of people who don't get jobs and who are going on Narega and other things. How can you continue to say that we are not able to give education even for those basic skill sets which require 6 months of training and zero education in terms of the formality of education? Second, whatever we are talking about the skill sets now, a large number of, I'm a big educator. People are now not looking at BCom, BSc, BTech, so and so. They're looking at other skill sets which really need to do, which we haven't even talked about. And that's a major thing that we need to do. So we have to focus on different lines of a thing. Just like you have said about the $5 trillion economy target, we need to pick up each of them and really take it end to end. So while in many cases we are doing a lot and we have the wherewithal and the direction from the Prime Minister, from various things, when you go down the line, there are lots of things missing. And we need to plug these gaps very quickly. My reading, 100% you can reach the $5 trillion economy. You can reach that target. The intent is all there. But there are gaps in each of these fields that we really need to fit. And if you really focus on the gap, whether it's in education, whether it's in skill sets, whether it is in textiles, whether it's in any other field of endeavor, my belief is India can do it. Whether it's on health, whether it's on the other things, we met the challenges once we focus on it. And we have seen in the health delivery side, we had a problem. We focused on it and we solved it. On the vaccination front, we had a problem, we solved it. On setting up various things, we were able to solve it because we focused not only on creating a policy level at the top level, but actually following through to see that each item is delivered. And if there were any gaps in any place, somewhere down the line, we lose interest. Humne ye kar diya. We have given this policy. We have told the bankers to give the money. We have done this to do so and so. How is it possible? If he finds that the industry is not going to be able to deliver or not able to get the land, where is he going to give the money to that industry for the purposes of doing that business? So the end-to-end working that we really need to do is missing. That you see in many other countries of the world, like Vietnam, like Bangladesh and others. And if we focus, and our focus in that is correct, in every field of endeavor, especially skilling, is very, very important in the next couple of years. I promise you, we will not achieve, we will overachieve. But if you don't, you will never achieve. So there's a big gap between the two.
Very, very, very well said, sir. I couldn't have put it better. No lack of focus on vision, but insufficient focus on execution and the nuts and bolts. Utterly fascinating discussion. Thank you all so much. Time is unfortunately up. I have so many follow-up questions, but I suppose it'll have to be another time. Thank you for being a patient audience. Please give a big round of applause to all our panelists.
Esteemed speakers, please stay with us on stage. As Dr. Hirandani just said, end-to-end will give us a whole new start. I'm going to request SK to please thank them and present them with mementos, token of our gratitude. Dr. Hirandani, you said that we don't watch television anymore. I also don't watch TV anymore. And by that virtue, I've made it into the new generation. And Mr. Swaroop Mohanty said that COVID-19 is the world's new chief technology officer. This remark should make it into all courts' websites. Thank you all. This was an extremely insightful session and a joy to listen into. And thank you to the moderator of this session. Please come together for a group photograph. And all of you can smile, thinking of achieving 5 or 6 or 7 trillion in the years ahead. Thank you all very much. And thank you, SK. Ladies and gentlemen, quickly moving on into the next session. The age that we will now do business in is the age of collaboration, cohesiveness, consideration, cooperation, and complacence. All cornerstones of the art of deal making. Like everything, deal making has also undergone not just a facelift, but a full body transition over the next 2 years. The next session at the Mint India Investment Summit 2022 is a fireside chat that aims to ignite a discussion on the opportunities and challenges in deal making in a transformed world. I'd now like to invite on the dais the speakers of this session who will only indulge in dealing and not wheeling. I'd like to invite on stage Rahul Chawla, Head Global Credit Trading India and Co-Head Investment Bank Coverage, Deutsche Bank India. Neeraj Inder Mohan, Head EY, Parthenon India. Saurav Malik, Joint Managing Director, Kotak Investment Banking. And ladies and gentlemen, please put your hands together and welcome on stage the moderator of this session, Ranjani Raghavan, Associate Editor, VC Circle. A very warm welcome to all of you. And Ranjani, it's over to you. I'd request you all, ladies and gentlemen, to please settle down, take your seats. We will shortly move into a beverage break. And that's where all of you can say your customary hellos to each other. But for now, we need to get this next session started. Ladies and gentlemen, we request you all to please settle down, take your seats. The speakers of the next session and the moderator are on stage waiting for all of you to settle down, please. Would you like to take this on?
Yeah.
Yes.
Yeah. Thank you, Gitika. So, welcome everyone. Welcome to our panel. I thought I'd start by recapping some numbers, some headline numbers that SK already touched upon earlier today. We had some 70 billion worth of investments that happened in 2021, over 40 billion worth of exits, fairly significant marquee deals. We saw Prosus acquiring BillDesk. We saw the Air India transaction go through. We also saw the DHFL transaction go through. So the question is whether this trend will sustain this year. And there are two views on it, that there's a fair bit of significant dry powder that's already been raised. So deal-making activity should not be so difficult and that it can go on. The other view, of course, is that there may be challenges because of the tightening credit cycle and the geopolitical tensions that we are seeing. So discuss the opportunities and challenges. We have our panel. Gitika has already introduced them. So I thought, let's jump right into it. Saurav, if I can start with you. Deal making has changed in many ways permanently because of the pandemic. I was wondering if you could take us through how 2021 was for you in terms of deal-making activity, and what key triggers you see this year for the trend to continue.
Great. Thanks, Ranjani. Is this audible?
Yeah,
okay.
yeah.
Excellent. Now, I think 2021 was a watershed year in many years. We approached 2020 with quite a bit of apprehension as the pandemic hit us. We were faced with challenges of existentialist challenges as to whether or not deal making or investment banking would survive in its own shape or form. In the first quarter and the first part of the year was extremely challenging. What happened thereafter was actually a floodgate of activity. 21 actually was almost overall double the level of activity compared to 2020. If you look at headline numbers, I think in 2020 we had close to about $110 billion of overall M&A and private equity advisory, which included, of course, the entire set of Reliance transactions, which itself was about 30-odd billion. But
even without that, at 85 billion net of the Reliance transactions in 2020, 21 we saw overall activity of close to about 135 billion, which is a massive increase. And coupled with the entire fundraising activity in terms of capital markets, I think deal makers not just forget the existentialist crisis that we talked about. I think it's pretty much here to stay. And it was fairly diversified in terms of activity. There is a feeling that tech dominated. But even if I look at the data, digital tech, consumer tech, SaaS, enterprise tech, I take all of them together, that only added up to about 40 to 45% of overall activity in 2021, which means that a majority of that was all the other sectors and industries outside of that. So it's been fairly broad-based, the overall activity. And going forward from there, I think in 2022, we see the early signs of that really continuing.
Right.
Yes, there is a certain amount of uncertainty in the context of geopolitical events in terms of credit tightening, but that's likely to impact a lot more capital market activity as opposed to M&A activity. And if I just look back, and we just completed our internal budgeting exercise last year, we've actually budgeted for an increase in budgets in the overall M&A activity for the current year as compared to last year.
Increase by how much?
It's internal targets about 15 to 20% increase of this year over last year.
Okay. All right.
So that's just to give you a little bit of a flavor of what we are seeing.
Yeah. Thank you. Neeraj, if I can come to you, what are the key drivers you think 2022? I mean, what are the key drivers of deal making in 2022?
Yeah, so thanks a lot for having me here first. Thank you so much for that.
Our pleasure.
I think I'll cover mainly the corporate side of things, because all the information I have is based on discussions with CEOs and senior industry leadership. Three major trends we are seeing which are emerging from the corporate world, and they are closely interlinked with the growth theme that everybody wants to follow. First is focus on acquiring technology. I think today what we're seeing is that everyone is realizing that access to technology is emerging as the most powerful business driver. The most successful businesses that we see around, even in India and internationally, they own technology. They are major, I would say, technology players in their own right, be it on chip manufacturing. Look at Tesla, they design their own chips, they block capacity, they get it manufactured, and they have their own entire stack of software. So even in India, if we were to look at a few successful companies, there are technology leaders emerging in their own right. So that is becoming a very powerful driver. And a very closely linked theme with that is ESG. So ESG is now, everybody is not only aware, it is becoming a prime business requirement. Therefore, this combination is possibly, I would say, 40 to 50% of the conversations that we end up having. People focus on these areas, because for ESG also, you need access to technology. Either it is better materials or reduction in energy consumption.
Right.
Second big theme which is emerging is the necessity to control your own supply chains, because in the last 10 years, what we are seeing is area by area, access to materials, key raw materials, is becoming tougher. Whether you look at rare earth minerals, if you look at an industry like fertilizer, access to potash, for instance, is constrained today. For battery manufacturing, you have to worry about lithium and cobalt. So, and in case of pharmaceuticals, you worry about APIs and key starting materials. So the need to go back and look at securing your own supply chains is becoming a core business requirement if you have to continue to manage your growth. The third big area, which is becoming very dominant now, internationally and now in India as well, is the need to be closer to your customer. And historically, if you see industries like pharmaceuticals, they have done a lot of M&A for the need to be closer to their customers. So you've seen multiple acquisitions by Indian companies in Europe, in the US. But now that theme is becoming much, much larger, because post the pandemic, even consumer industry, be it packaging related, be it other raw materials related, the B2B customers are also demanding that you get closer to them. And I would say the deal activity is seeing a very heightened activity across these three, at least from the corporate standpoint. And that's where the challenge lies, because if you want to be, let's say, closer to your customer in Europe, reality is that in your own industry, there aren't that many targets left. Likewise, when it comes to technology, take electrification in automotive, a lot of clients ask us to do searches, and reality is that there is nothing ready available today.
Right.
So either the technology is 3, 4, 5 years away from maturation, or it's already gone. And that's where we are also seeing in India emergence of a very, I would say, new trend by Indian standards, even though it's been prevalent in the US for a while, which is the corporate VC type investment strategies where you put in money at an early stage with the option of acquiring the technology or a company later on.
Right.
And this was the primary mode of investments in the US, if you go back 20 years, for an industry like biotech. Now we are seeing the emergence of the same trend in India, where you would see a battery manufacturer putting in money in a battery startup, or an automotive manufacturer putting in money in an automotive startup. Because the idea is not to make money out of the investment, but to secure access, because tomorrow that access might simply not be available. So these are the dominant themes that we believe will continue to drive both M&A activity, and of course they're tightly linked with the growth strategies everybody wants to follow.
Yeah, I want to come back to you on the technology
Sure.
bit, and
Sure.
also the CVC bit, the corporate venture capital strategy. That's quite interesting. But I'll first come to you, Rahul. What are the drivers that you see driving deal-making activity this year?
Hi, thanks for inviting me here. I think to the points that Saurabh and Neeraj mentioned, I'd add 2, 3 additive from there. One, you look at the demand and supply of capital. I think the supply of capital, especially the global capital,
right,
that's ready to come and invest into deals, hasn't gone down. If anything, the point Neeraj mentioned, whether it's venture capital or growth or buyout funds, you only see increasing competition and increasing pools of liquidity, more dedicated Asia, some India funds as well. That's one side of it. Second, I think there are certain sectors in which we as a country need capital, infrastructure, technology is talked about, but I would say in that, again, you see that the drivers are going to be not the availability of capital, but just the demand and the price for the assets. Deal making at this point of time is taking a little bit of pause, just the global uncertainty, driven by both what's happening in geopolitical sense, as well as the economic sense that, will Fed raise interest rates next month, the month after, how will inflation be tackled across the various large economies of the world. I think our own perspective is that it will take another month and a half, 2 months for the cycle to set in. People will recalibrate, and then, the new normal may be a little higher expectation of interest rate environment, and therefore, some amount of adjustments in your ROE models, and then back to deal making. And I think as Saurabh mentioned, the capital market uncertainty will actually only fuel the private side growth and opportunities on deal making, because as a demand for capital, you will have one lesser avenue, or one avenue which may not be as open or available for everybody. I think the second point, generically, we see as the deal making has become more and more driven by foreign capital in this country, has been that flight to quality. The top 2 or 3 players, and I will transition a little bit into the debt side also, you see that they will not have an impact in their ability to access capital in whichever form and shape they want to.
Right.
So sector agnostic, but who you are, what you bring, both as a customer segment or technology or market penetration, will lead to a better ability for you to raise the capital, and therefore the differentiation between companies who can access capital easily at their price and can't will become a challenge. I think a little bit of a flavor of debt, because that's some part of my day-to-day job as well. I think the infrastructure sector is probably going to see the worst impact of that. When I say worst, meaning that's one sector which needs ROEs to be matching between the seller and buyer, and that tends to, in a rising interest rate scenario, need the maximum amount of recalibration, because every 20 basis points, given that you look at a long-term asset and the equity margins anyway in a competitive scenario like India are thin, will need recalibration. But again, amount of assets in play there and the demand for those assets and the story of consolidation, which is going to be the play that will happen in that sector, I don't see that abating. I just see that there's a hiatus which will again, once you have recalibrated, people will be back on the table to discuss genuine transactions. So I see second, third quarter to be a very active period.
Yeah. Sort of your views on that. What sectors do you see? And if you share his sentiments on the risk factors as well.
Thanks. I think it's quite interesting. It's an area of debate and discussion. But I just want to add a few points to what Rahul just said. So two or three interesting trends we've noticed in the last 12 to 18 months. One is really we are in a different world now compared to a decade back. There is what we call a need for speed.
Right.
So the larger companies want to get larger, bigger and faster, and they are competing for assets left, right and center.
Right.
So there is a need for speed at this point in time, and that is also seen as a competitive edge. So that's driving deal making, number one. Second thing that we are really seeing is that gone are the days where everybody said that, okay, I'm going to do everything myself. You just can't. And people have come to that realization, whether it's, digital companies wanting to go and build an omni-channel presence. A couple of the transactions we did last year, whether it was PharmEasy's acquisition of Thyrocare or Delivery's acquisition of Spot On, and we helped the Tatas in terms of Big Basket, 1mg. These are all examples of, and it's in some cases it's the old world companies acquiring digital businesses. In some cases it's the other way around. So you can't just do everything on your own, and people kind of realize that. Third is availability of capital. I mean, we have private capital that's available, and debt. I mean, we just announced a transaction last month where our client has now raised short-term debt financing at sub 5%. I mean, that is an example of the kind of liquidity that's available in domestic markets. And last but not the least, I think generationally, we have come to a place now in India where over a period of time, businesses are more owned by financial investors, institutionalized, and families are not necessarily so hung up about the social angle of selling businesses. I mean, it's become a lot more acceptable, and also, business models are changing. The newer generation wants to do something a little bit different with family wealth, and so on. So these are really driving M&A in a big way, and so to say. With regard to the sectors, I think it's going to be very, very broad-based. And we were having this conversation earlier with Neeraj. What is a sector? If you do a fintech transaction, is it a digital transaction? Is it a FIG transaction?
Or a financial
is it a consumer tech transaction? I mean, you really... So it's going to be fairly broad-based. It's going to be driven by availability of capital. We do see companies which have a digital angle to it playing a more meaningful role, or companies which are backed by sponsors playing a more meaningful role, and it's going to be that as opposed to really necessarily sectoral.
Right, right. You mentioned need for speed. Do you see companies also focusing a lot more on sectors they want to be in and being more open to divesting a lot of their businesses that they don't find value in?
Yes, indeed. I mean, core competency is back in some way. So companies that believe that certain parts of their business and assets are deemed to be non-core, they want to get out of that. But more than that, it is, we are seeing new age companies wanting to build a business model, multiplicity of businesses, and competing with each other to get to that. So that, I think, is driving M&A in a big way. So
right, right. I also wanted your thoughts on, the question of valuation. You appeared to suggest that capital is no longer a challenge. It's more about whether the asset is available or not. In that context, do you see, I mean, last year we saw companies raising capital at unicorn valuations at a very rapid pace of growth. Where do you see that going this year? Is the discussion of valuation still relevant when it comes to deal making, especially when there's so much scarcity of assets? Saurav, and then maybe Neeraj, and then we'll come to Rahul.
Maybe I'll pick that up first.
Yeah.
I think valuation always remains a topic of discussion always, but if I step back a little bit and people talk about froth and capital markets and this and that and the other, we track an interesting benchmark, which is the Sensex forward price to earnings multiple, okay? Now you may argue that that's not representative or whatever else, etc. But taking that as a benchmark, we are currently trading at about 13 to 14% above the 5-year long-term average. Now there are two ways of looking at that. You say it's above the 5-year long-term average. But another way of looking at it, it's only 14% above the 5-year long-term average. So it's not as if valuations are completely out of whack, so to say. Okay, there may be some transactions which move is away from the median, so to say. But that's what I say. So I don't think valuations are significantly overstretched in that sense.
Right. Neeraj, your view?
I think the valuation question is fair. It's both, I would say it's a combination of valuation and availability because ultimately it's demand and supply. So there are fewer companies and people want to buy them. So obviously there's that angle as well. So I would say there's a lot of money waiting on the sidelines. And I think public markets have become a very large, I would say, contender for those deals because at least in the private equity world, you have two options today. You can either straightaway take your company public, and the fact is that if IPO market continues to be hot, the valuations will continue to be where they are, right? So to come back, I think valuation question needs to be addressed in two parts. Number one, there is a lot of money waiting on the sidelines, partly because people want to be disciplined. And if you allow me to go back a little bit, I think in last 10, 15 years, India has seen an evolution in terms of ownership structures. So from old style ownership, first we went from owner-manager, then to a professional management, but old school ownership. Today, what we are seeing is professionalization of ownership, partly because there's so much of private equity money coming into the country. We are also seeing that the traditional business houses are also taking a completely different approach when they look at their investments and their wealth, overall wealth management. So you see family offices who are more or less as professional as any other investor on the planet. So what's that driving is that when it comes to M&A activity, it's no longer about empire building. You have to be very focused in terms of the business outcomes, whether it will be value accretive or it will dilute the value for shareholders. So that drives the discipline behind looking at valuations very carefully, number one. Number two, there is a lot of money waiting on the sidelines as deals keep on happening. There is still a lot more money sitting out there. So if valuation is correct, at least my gut feel would be that the M&A activity or deal making activity might go up because a lot of money sitting on the sidelines might enter the market at that stage. So that's the valuation part. And I would say that ultimately it is demand and supply. So long as we have very robust IPO market, public markets, that also competes for the same assets. Therefore, I'm not very sure that valuations will correct in a very big way, despite the cost of capital going up. And if you look at it on a long-term basis, this year, I think the market is pricing 5 to 6 rate hikes by Fed. But that still takes the cost of capital to about, at least the Fed rate, to about 2%. And that's not prohibitive.
Right.
Particularly in an economy where you are anticipating that the economy as a whole will be growing by 7-8% in real terms, which means nominal growth is likely to be more like 13, 14, 15%. In that economy, 2% cost of capital is still not prohibitive, by the way. So it might be, a lot of people might be hoping that valuations will correct, but not so sure.
Right, right. Rahul, I'll come to you, and then we'll open up the discussion to the audience. So please keep your questions ready, if you can.
I think, I put it differently, sitting where the three of us said valuation is a game to either blame the bankers or praise the bankers for what they achieved out of a particular deal.
Yeah.
And I think at the end of the day, it's always going to be, battle between which market what. But I think the two interesting trends, and Neeraj touched upon it in a perspective, is that, when when private equity money came into the country, the exit for that money was always seen as a public market or some form of a market where, it was never a secondary sale from one private equity to the other. I think that anathema or no changed a few years ago. So to me, the valuation has now become more a conversation around what do you see the value from where it is and where are the benchmarks to that. And I again go back to the second thing I think which sort of also touched upon is you call it need for speed or the quality or the larger players wanting to become bigger. I think when it comes to people who can demand their price, you will get what you want.
Right.
And the third, fourth, fifth players in that segment have to accept the price that they are getting if they want to survive. So I think to me those are the two trends that we will see going forward even more.
Right. If there are questions from the audience, we can take them now. Otherwise, I have okay, I can see.
Hi, just wanted to check if you could give us a sense of deal making in the distressed asset space. Are we going to see any changes there?
Rahul, you want to take that?
I think what you have seen in the distressed asset space in the last 4 to 5 years has been a lot of focus and attention on the marquee assets and larger names. I think the environment logically will now shift towards smaller assets, more trickier assets where aggregating the assets between the current holders and bringing it under the realm of the new bank, reconstruction bank that has been set up is going to be the name, is going to be the game, how it's going to happen. And obviously, post-pandemic era, you still have to see the retail sector distress play out. And I think the retail MSME sector play out. And that's something that, I think is the focus of both the regulators as well as the players involved to see how best to handle those. So I think those two trends are going to be the way deal making will happen. But I think the platform is established that there is a system which works. We can all crib about it takes time, some things which are not right, but I think some of the larger resolutions have shown that the system does work.
Any flavor on which sectors and valuations in those?
I think on distress, it's less a question of sectors, it's more a question of the need. And I think, where the resolution come, to me, it's going to be the MSME segment where the focus will shift now. And especially where you see assets, not real estate, but real asset value. So if you have asset value, I think those will be the flavor of, the thing. And given the way the commodity cycle is today, I think if you get assets in that sector, I would think there will be a lot of demand for those assets in particular.
I think we should end on that note. It says that we're out of time. Thank you so much. May I request the audience to give them a warm round of applause? Thank you.
Done deal. Madam Moderator, thank you for moderating that session. And esteemed speakers, please stay with us on the dais. We'd like to thank you, and we'd like to express our gratitude through these mementos that will now be presented to you by the moderator of this session. And ladies and gentlemen, once we've thanked them, we will show you another very interesting factoid. ESG, the hour of reckoning, but post this group photograph. Thank you very much to the speakers, and thank you to the moderator. And coming up on your screen, this very interesting factoid, ESG, the hour of reckoning. And that takes us into the next panel. Climate change, ladies and gentlemen, knows no borders. It will not stop before the Pacific Islands, and the whole of the international community here has to shoulder to bring about sustainable development. Pointed out Angela Merkel. Now, these are apt words from one of the most powerful women in the world. A universal, stark, and inescapable reality. Hence, the need of the hour for businesses across the globe is to go the ESG way to plan their role in sustainable development. ESG transformation is catching on as a new age movement that companies have to embrace for better survivability and performance and the overall good of planet Earth. Environmental, social, and governance criteria are a set of standards for a company's operation that socially conscious investors now more and more use to screen potential investments. Environmental criteria consider how a company performs as a steward of nature. Social criteria examines how it manages relationships with employees, suppliers, customers, and the communities where it operates. And governance deals with a company's leadership, executive pay, audits, internal controls, and shareholder rights. This is one of the most significant trends to hit Indian shores. In the coming years, this theme will drive strategy for corporates and investors, and thus will shape a sustainable future for corporate India. This is indeed the hour of reckoning, the moment of truth to sound the bell. I'd like to invite on the dais the speakers of this session. Hetal Dalal, President and Chief Operating Officer, Institutional Investor Advisory Services, joining us virtually. Dr. Mukund Rajan, Chairman eCube Investment Advisors, joining us virtually. Rishi Pardal, Managing Director and CEO, United Breweries Limited. Nalin Moniz, CIO, Alternative Equity at Edelweiss AMC. Ankur Thadani, Partner, TPG, Growth and Rise Fund. Shruti Rajan, Partner, Trilegal. Please join me on stage. I'd also like to invite on stage the moderator of this session, Srinath Sridharan, co-founder 4P Consulting. Thank you all for taking the time out and joining us here to be a part of this panel. I now hand this panel over to the moderator.
Hi, good afternoon. So, a provocative topic, ESG. I mean, is it the new buzzword or is it the new mantra? We used a word called strategy for 2 decades to probably even delude ourselves. And now we have ESG as the new space. Having said that, we have practitioners, we have advisors, we have investors on this dais, on the panel. And it'll be interesting to see the perspective, especially now that ESG has got the regulators' attention, the capital market regulators' attention. The top 1,000 companies to file their BRSR from next year. The investors are demanding and expecting higher standards of all the 3 space, which is E, S, and G. But what does it mean? And how ready are we? And this panel is going to actually ask those questions. We have Hetal and Mukund, both who have seen it from the advisory space as well. And is India Inc. actually ready with talent? That's one question that I want to provoke this panel to address. Are we ready for granular disclosures? We disclose, but how granular are we? How higher standards can we set to ourselves? And do we have any learnings from the global markets that each of you come from? What are those that we bring in? And more importantly, is actually ESG a new thing at all in India? I mean, it's not as if India has not had any of these aspects. We have culturally imbibed our consciousness towards societal norms about environment and governance. So there's something newly packaged, but not necessarily something new. So with that, let me open the panel with Hetal. Hetal, your points, please. And what we'll do as a format is each of the panelists will go around for 3 to 4 minutes for their observation, and then come back for pointed interjections and questions. Hetal, over to you. Hitala, you're not audible. Yeah, we can hear you now. Thank you.
End up here, right? It's begun as the tragedy of commons. Most businesses, whether you look at it in India or even globally, effectively looked at profit maximization at the cost of all else. So therefore, in pursuing the personal gain, the common good sort of got lost. And this is true for governments, it's true for individuals as well. It's not simply penning corporations, but we're here to talk about, corporations, and therefore you sort of focus around that. So there you are. Therefore, you need to have a more structured mechanism of thinking about profits, people, and the planet. Essentially, your ESG, right? But for a company who owns the ESG agenda, I mean, if you sort of let me take a leaf from what C.B. Bhattacharya from the University of Pittsburgh keeps talking about. Is the hierarchy of how the ESG agenda gets addressed in companies, and it's a little bit like the Maslow's hierarchy of needs, right? At the very bottom level, you have compliance. Regulation says I need to have fire safety everywhere. I have it, right? Then you move to sort of risk mitigation, where you say that I'm going to set up a plant in the interior of the country. Should I not just adopt the entire village, give them, education, give them health care, and therefore ensure that I'm able to always access labor and the labor will not be militant, right? The third is to say, is it a competitive advantage or opportunity generation? So instead of using cotton, we're using modal, it uses less water, it's biodegradable, comes from trees. So therefore, you should buy my product vis-a-vis, everything else. And really the fourth level, which is essentially what you call, the self-actualization in the Maslow's model, is to say that are you really running the business through the lens of sustainability? And that's the fundamental way. If you do something like that, then every operating decision that you make will have the focus of profits, people, and planet. So given where we are, right? So how do we pull ourselves from here? And there are a couple of things which all need to work together. One is to say fundamentally addressing corporate culture. Now, if we keep asking the questions that do boards even address corporate culture is one of the things that we look at. But given that ESG has far more operational mechanics to it, right? In terms of saying, how do I, if I have to reduce carbon, how do I do that? Do I switch to renewables? Can we streamline the manufacturing, reuse waste, reduce waste? A lot of these decisions are operational in nature. Therefore, one is simply addressing corporate culture and the fact that that needs to change. It is no longer about squeezing the last penny or choosing the last rupee, but to simply say that I am now looking at a much more holistic and optimization kind of a context, right? The second is setting responsibility at the leadership level. How is executive remuneration really set? When we look at disclosures, and today we track 900 companies, right? When we look at disclosures of CEO compensation, they're very, very sketchy, even in terms of just, how is variable pay determined and paid itself is sketchy. In most instances, you'll get 4 parameters. Most of these will be return ratios, profitability, sort of revenue growth and market share, those kind of financial parameters. So therefore, setting responsibility for ESG at the leadership level, embedding some of these targets into CEO pay or even the executive leadership pay is really what will drive the entire system to work towards it, right? I mean, what gets rewarded will get measured and therefore get done. It's a very fundamental issue. We looked at, in 2021, we looked at the top 100 companies CEO pay, right? The top 100 companies account for about 70% of market cap, give or take a little bit here and there, right? And if you look at the alignment of pay versus performance, and this is during the COVID period, right? If you look at 2019 to 2021, essentially 2020 and 2021 is really where the COVID period hit. Right? We've seen CEO pay actually outpace company performance for sure. And the number of companies where this has happened has actually increased. So CEOs have still got themselves paid while a lot of the ecosystem is struggling around COVID. Same issue with suppliers, right? Number of companies which delayed payments to suppliers has actually increased. during the COVID period. And the COVID period has actually impacted SMEs far more. Most of the suppliers are SMEs. So therefore, you're saying that, while there's already stress on the SMEs, you increase and delay payments to the suppliers, increasing the stress even further. And that's really the gap in how sometimes ESG gets looked at. So therefore, ensuring that there is leadership level, you're actually embedding some of these metrics into CEO pay will sort of allow the entire system to therefore look at itself more holistically. Right. And the third is to say that there has to be an ecosystem that rewards better ESG performance. I mean, there was a factoid which said that, ESG funds have clearly outperformed most of the indices. And that's really where the investors sort of kick in and they have a role to play. And we've seen that even if you just measure very narrowly, look at governance itself, right? Better governed companies tend to perform better on price as well as, have lower stock beta. And you're now seeing this in terms of the funds of the, performance of the ESG funds as well. And it's not just sort of looking at it from the equity standpoint, right? Even from the lender's perspective, and actually sometimes more so from the lender's perspective. One is that the banks look at their own ESG structures, right? And for them, it's a lot more social and what do we do about e-waste rather than environmental. But what do they do on the lending side? Are they looking at, the entire sort of ESG practices of companies? And finally, ESG poses long-term risks, right? So therefore, if you're saying it's long-term risk for a lender who's going to be sort of lending money for a 5 or a 10-year time frame, depending upon the nature of the project, this is something that lenders also need to sort of get into, and more so. Regulators also have a role to play, and as Srinath was talking about the fact that the whole BRSR has come in, and really what is that? That's the regulator pushing companies to disclose data with essentially the view that therefore there will be some kind of a tracking mechanism which companies will finally build in. I don't hold a view which says that, ESG is new to India. It's as Srinath says, I tend to agree with that culturally we think of the planet and the environment far more. It's embedded in how we look at some of these things. But putting data and tracking it brings a lot more clarity. It creates a sense of comparability and therefore fosters a certain set of competition as well among companies. And I think that's, to me, this is really some of the ways in which an ecosystem can be built around to push companies forward on their ESG trajectory.
Thanks, Hetal.
I'll stop here.
Thank you. So this is where I want to bring the industry practitioner. I mean, I want to bring in Rishi with a provocative question from the man who runs the King of Good Times. Does goodness pay? Does ESG actually pay?
Well, what's good for the planet is certainly good for business. And I was going to say, you asked the question, is it a buzzword or is it here to stay? My personal view is it's here to stay. And really there are 4 things that are driving this, right? On the one hand is the real impact on the planet. So you have a situation, if you watch every year, that the Earth overshoot day, the day when Earth can stop supporting its consumption needs, keeps on coming forward and forward in the year. I think it's reached up to August now, or even earlier. And as a result of that, actually I find in my professional journey, we find as a company that consumers, especially the millennials, the Gen Zs, are asking the right questions of brands. They're not just convinced to consume, but they want to know what lies behind that choice, what practices, what do the brands really stand for, how do they produce, what do they put on their packaging, do they treat their supply chains fairly. And this is a real huge pressure on all of us in business. And when you combine that then with now the kind of work that is happening in the investment world and folks taking the lead on evaluating companies on this parameter, I think it's really forced companies all over the world to take ESG at the heart of the agenda, right? Hetal spoke about, whether the metrics of ESG find a role or a place in CEO compensation. Well, I can start to see that they do. So the journey is still very long. We are start of it. Not for a minute do I believe that, this is going to be smooth or linear in any way. But certainly from my perspective, doing business with a purpose and doing well by doing good, these are all becoming center of plate. And over the next few years, this will become even more important, in my opinion.
Thank you. Thanks, Rishi. So I want to bring in Shruti here from the regulations point of view. I mean, sometimes I wonder how does somebody actually keep up and cope up with regulations and the circulars which keep coming in our Indian regulatory space. And especially a topic which is a long haul topic, as Rishi and Hetal also pointed out. How does one actually plan for not just compliance, but more about the spirit of it?
So, I recently read an article which said, who's going to save the ESG movement from itself? And the answer at the end of it was the regulators. Today, the only thing that stops ESG from becoming tokenism or becoming a marketing gimmick is really how regulators, I wouldn't say regulate, but at least exercise some supervision and oversight over the industry that puts out the information, which is the companies, and the industry which consumes the information, which is people who prepare the reports or investors. And I think, we've done a fantastic job so far in India. As I'm sure all of us know, SEBI is pioneering the space towards regulating ERPs, and you will very soon have a set of regulations that govern how ESG rating providers must be regulated. The draft is still in a consultation paper form, but whatever little we've seen, I think is very encouraging. It's principle-based, doesn't go into the nuts and bolts of, what are the symbols you should use, what are the metrics, benchmarks, etc. But it does thematically lay out what the regulator expects, the minimum standards of behavior that they expect from ERPs. So I think that's one very encouraging sign on the side of the people who are putting together the report that investors and companies will rely on. Equally, from the company's perspective, you have, obviously the BRSR report, etc., that we just discussed. The one thought that perhaps we can discuss as we go on in the panel is really what happens after that, because as a lawyer, my vantage point is naturally one of, say, risk and litigation, and I can't help but wonder that where do these disclosures take you? What is the liability for management? Is there a professional liability that comes from material misstatements? Are you looking at tortious liabilities for environmental claims? How much is too much in what you say? What can go wrong with the rating providers in terms of the reports they put out? I think the list is endless, and yeah, a lot to think about as a lawyer.
Thank you. This is where I want to bring in Ankur. So, as an investor, she spoke about risks, and what are the mitigatory factors that you look at? Otherwise, everything looks rosy. Everything, the buzzword, sustainability, green. How do we stay away from one, green shaming, at the same time evergreening as well? Between the two, how do you ensure that you actually invest in the right assets?
Sure. Look, I think we all know that, I think as Rishi said and as Hetal said, right, this is not a buzzword. I look at this as a generational challenge and a generational opportunity, right? And they're two sides of a coin. But on your specific question, I think there are two aspects to it. One is the entire market is getting rewired towards a climate economy, right? And it's not just about ESG being one of the things that CEOs have to adhere to, but there's a recent Bank of America report that came out, which said that globally, companies that actually rank high on ESG benchmarks have effectively 10% lower cost of capital than other companies. Now that is the market forces sort of acting at play and saying that, look, you are now forced to be ESG efficient, you're forced to be ESG efficacious. Only then will you get lower cost of capital, right? That's the market playing in itself. But to Shruti's specific point, look, I think the risk is today there are just way too many benchmarks, way too many ways of, in some ways, reporting ESG and measuring ESG, till there is no sort of global benchmark or no global definition of what people have to deliver on. It is very similar to financial accounting, right? I think, I can almost hazard a risk and say that 10 years from now, Rishi would be reporting not just a annual report, which is an audit report, but also an ESG report. And that will have to have a benchmark like you have GAAP. I don't know if people know, right? Accounting standards globally were there for 70 years. Yet it took 8 years for the world to come up with GAAP, which is the accounting standard. We don't have 8 years to wait for the ESG standard, right? The opportunity and the challenge is here and now today. So there has to be that globally accepted ESG benchmark on which companies can and CEOs and teams can actually benchmark and regulators can measure to say, are you up there on ESG or not? And I think that's a key sort of impediment to getting on a globally compliant level.
Thank you. So let me bring Mukund into the conversation. One of the other hats Mukund wears, apart from being an ESG analyst and an investor and somebody been in the corporate world, more importantly, author. One of the fascinating books on ESG. Mukund, you have written the book called Outlast. Do you really believe that companies will actually outlast the markets?
That's what we're discussing, aren't we? No, absolutely. I think in the long term, I think we've heard from the others as well, I think the focus on ESG is going to be a key determinant of success. In the short term, however, different story, both for the kinds of commitments that you see from companies and the kind of pressure points that are beginning to build up in the Indian system, be it from the regulator, from investors and others. Maybe take an example, let's say, of the auto industry. Look at the two-wheeler industry. A few years back, you will recollect the Niti Aayog came out with this proposal to mandate the conversion of all two-wheelers in India to electric by 2025. And huge resistance, I think, on the part of the industry to that. A lot of talk of stranded assets, the kind of investments that had been made in the BS4 to BS6 migration, and this was just one bridge too far for the industry. And guess what's happening today? I think the market pressures themselves are pushing a number of the two-wheeler manufacturers to come out with a slew of electric products. So it does take time sometimes, and sometimes in the short term, the reactions aren't very favorable. But eventually, I think the trend is in the direction of all of these different pressure points coming together and forcing change. And I think a series of global shocks in the last decade and a half have played their role in persuading people that it's better to do these things faster rather than wait. I think going back to the global financial crisis, the Arab Spring, the hashtag #MeToo movement, and most recently, obviously, the concerns around global warming and what you've seen with COVID, the fact that when nature revolts, there's nowhere to hide, no matter how wealthy or powerful you might be. So I think people now get it. And I think the more forward-looking corporations are beginning to embrace ESG in a very positive and constructive way. It doesn't mean that they're going to make changes overnight. Take net zero, for instance. Many of the announcements around net zero are 15, 20, 30 years out in time. Unilever, which is a role model, I think, in sustainability, is talking about 2039. So it's not as if anyone is expecting them, nor are they themselves committing to do something tomorrow or day after. But yes, I think putting in place a roadmap and explaining it to the market how seriously they're taking these issues is becoming, I think, a key factor in really sifting the great and the good from the ones who are going to be caught out, I think, by the market sooner rather than later.
Mukund, let me bring in Nalin here. Nalin, do we have enough demand? I mean, or do we have enough on the supply side? Do we have enough companies to invest into?
So Srinath, audible? I couldn't agree more with the panelists that ESG is one of the defining trends of this generation. And it's not just the right thing to do from the heart, it's the right thing to do financially as well. If you did a very simple analysis of a company that was earning a 15% return on equity and 10% sales growth, 73% of the company's value is determined by its terminal value. And that is what is impacted by ESG in the long run. However, there is today a big slip between the lip and the cup. We all acknowledge that ESG is important, but at least domestically from investors, there simply isn't enough demand for ESG investments. The mutual fund category is only 12,000 crores in aggregate. Schemes have not been able to perform. In fact, over the last 5 years, the BSE 100 has delivered 14.5% versus 13.6% for the ESG category in average, and not a single scheme has been able to outperform. The beta of ESG funds is 0.97. So it shows that there isn't lower risk when you add these ESG filters. So there is a lot that is desired from the implementation perspective, and that is holding back the demand from investors for these kind of investments. If we can fix that, the demand is going to be unlimited.
So I have a follow-on question. How granular are those disclosures or the inputs that you take into ESG investing? I mean, at this point in time, as Ankur mentioned, we don't have much of granular data that's available on ESG space. So when you make a call, when you take a call on a company basis their disclosures or your primary research, what are some of those red flags that typically alarm you?
So Srinath, we also manage money for Indian investors on the mutual fund AIF and PMS platform, and we also manage money for European investors on the UCITS platform. If I were to contrast disclosure standards on the UCITS platform, they are incredibly granular. We are being asked about energy usage, water emissions, unions, executive pay, gender gap ratios, and so on and so forth. But domestically, nobody is even measuring this. Nobody is asking us about this. And please pull up the portfolios of any ESG mutual funds. They look indistinguishable from a typical multi-cap portfolio. So we have a long way to go in terms of standards being adopted and adapted domestically.
Sure. Thank you. I want to bring in Shruti here. You mentioned about litigation risk as India moves on to the ESG journey, and then follow it on with actually asking the CEO of a large corporate saying, how is he going to find the litigation risk when he rolls out as the leader? Because there's a culture of, if there's a culture of fear, a market fear, saying that I am liable for litigation, I mean, you're not going to be able to attract enough talent at the senior level.
True, but I think, look, litigation vulnerabilities it's a good sword to have hanging over your head at some point, right? Because it keeps you honest, it keeps you real in terms of the information that you want to put out. I think that risk in itself is a litmus test in terms of what is it that you want to say, how far do you want to go in terms of, just to take the example of what you said from a social parameter standpoint, how are you really packaging the gender gap or the wage gap in your BRSR as and when it comes out? How are you, packaging in your annual report the steps you're going to take to bridge the gap? Those are statements that, just like we do for IPOs today, if they're going to become statements which are out in the open and, which cannot be substantiated in any manner, you will run the risks that companies today run for making, open-ended statements as a part of their IPOs. So I think the basic principle does not change. The fact that there is a litigation risk, I would think, it actually enhances your ability to say it like it should be and make sure you're covering for it.
Yeah, I mean, if I look at it really, for me, it's first clarity of purpose, right? Where do you want to go? Everyone is today agreed that the current ways of doing business and the legacy ways of doing business has to change. If I was looking at the World Economic Forum, I think they've come up now with a list of 21 plus 34 metrics that constitutes, the right framework on ESG in terms of metrics to be looked at. So if that's the clarity of where we want to go, I think the starting point is honesty of where you are. And so therefore the first few years in terms of the disclosures, in terms of bringing out or putting the moose on the table, I think is acceptable. Because that's just the reality of where we all are. And if we stop censuring people for where they are, and look at that clarity of purpose and the honesty and transparency with which they are starting their journey, and then periodically review the progress, I think that's the way to go, right? In the fear of getting a lot of litigation or being punished too early in the journey, I don't think any progress is possible. The reality is that all of us have consumed more products and services collectively as a nation, as a globe, than the earth could support. And now that we've started this journey, we've all got to be clear that there's going to be first the bad news before the good news comes along. So I think that's the way to look at it.
Thank you. So let me bring in Hetal, your question. You track the regulation and the corporates who toe those lines or don't toe those lines. And how competitive are our ESG framework? I mean, they're still evolving. And how competitive are they? And do you think there are any learnings for us from the credit rating space? I mean, we've had credit rating agencies for long. and yet we seem to be missing early warning signals in the markets. So what are the learnings for the ESG rating agencies?
It's the answer a lot to extent is a lot of it is developing. Let's look at the credit rating model, and I know that's easy to say that rating agencies have failed. I think the one piece I would recommend we also think about is the fact that all rating agencies haven't failed all of the time. Some rating agencies have failed some of the time. The role of rating agencies is essentially where you are on the ESG framework as well. They all started at a point in time where interest rates were fixed. So what they allowed when they started off was access to finance, right? And over a period of time, that came into pricing, and rating agencies have been an sort of instrumental player in terms of developing the debt markets. And this is not in defense of the rating agencies. I'm simply saying that drawing a parallel. So today we are saying that you have, this entire ESG ratings which are coming out or rankings which are coming out. SEBI's put out a paper, and SEBI's idea is to create a certain degree of comparability or a certain framework around those who are also who are going to provide these services, and therefore create some degree of streamlining and control as well for SEBI, right? I think because one of the challenges of any model and any framework is the quality of data itself. Today for corporate India, and it's again a mixed bag. When you look at some of the larger players, they have far more sophisticated tracking mechanisms than the relatively smaller players, right? And the idea, therefore, for the country, for the regulator, is that you put all of it together, and the market itself has to move forward. And therefore, having some of these, evaluations or independent assessments and disclosure requirements, therefore, compels the market to get onto the train, so to speak, right? So fundamentally, one is just the challenge around the data. And to be fair, the data challenges are there across the world. You talk to any of the companies, even globally, this is comparability of data becomes a challenge in the ESG space. You have the ISSB, which is now going to come out with standards for sustainability reporting. And hopefully, much like the accounting standard, these would create a certain degree of comparability. But I think the models, by and large, are still to be tested as far as Indian markets are concerned. So it's a little too soon to say, but I would say that the evolving and the degree of expertise that you need is also developing. Nothing that you start from the initial stages, or when you decide to start something, you're not going to get that talent in the market. It all has to be developed, and everybody learns along the way. And that's really where the entire ecosystem for the assessments is as far as India is concerned.
Bring you into the conversation again. If there were a wish list that you seek from corporate India in terms of behavioral traits or value system, you spent a lot of time in an enterprise which emphasizes values or value on values, but that's not a very, very common trait in corporate India. So what are those 2-3 wish lists that you would have?
Very basic, I think, asks. The first is codes of conduct. It seems something very basic and very simple, but many companies don't actually have a particularly refined code of conduct, if indeed they have anything at all in their organization. You talk to many of the MSMEs, for instance, they've even not heard of this concept of having a code of conduct. So I think trying to put down really what it is that is important to your organization by way of values, and then trying to link that to really your vision and your mission as an organization. These are words we grew up with, right? The basic things that you try and put together in a corporate, and yet most companies don't have them. Many of the even larger companies in India today have vision or mission statements that are actually not fit for purpose and that are now quite dated. I guarantee you, if you do a search of many of the mission statements of corporate India today, you'll find that actually in the last 5 years, they've not really been tweaked or changed. And considerations like sustainability, considerations around employee well-being are somewhat new for many of these companies. They've not actually kept pace. So I think the first place I'd look for is, have you actually marshaled all your resources to figure out as an organization what it means to do business in this country? The second is another thing that we keep hearing about, corporate purpose, right? Which is really your mission. Are you a purpose-driven organization? What do you really care about? And how do you align your stakeholders behind that? So these are, I think, very basic asks, which if you apply your mind to, can then actually result in significant streamlining of all the things it really stand for and how important ESG and sustainability considerations will indeed become to your future. If you don't go through that exercise, then I suspect you're going to be ending up, initially at least, with a lot of sort of tick the box, compliance based efforts, which don't actually go into the heart and soul of who you are as an organization and what you really stand for.
Good. Ankur, this is a question for you. The market general perception about ESG is everybody thinks you'll have to retrofit to get there and that it's going to cost a lot of money to get you to ESG compliance. And when you are seeing deals, when you're speaking to companies to invest into, what are those concerns that they're flagging off?
So it's not surprising, right, Srinath? I mean, when a market needs to rewire, when an economy needs to rewire, it needs fundamental capital investment, right? There are some reports out there which say about $150 trillion of capital is required for the world to sort of become climate net zero, right? Now, that kind of capital somebody has to provide. Public sources of capital, private sources of capital have to step up and participate to provide that capital. So capital need is certainly one aspect, right? Second, new business models will evolve. And companies either have to adapt to new business realities or have to essentially ensure that they execute to that, right? And again, I'll draw a parallel here, technology disruption. Most companies didn't realize how to adapt to technology disruption for the last 2 decades. And you can see how many of them have suffered versus those who have adapted and how well they performed, right? And that expertise on how do you pivot your business model to become compliant with ESG and to become ESG efficacious is going to be very similar to what a tech disruption did to these businesses. And it's top of mind for CEOs to think about, right? And some of the companies are thinking of it as a spotlight to say, I'll focus all my effort and try and get to ESG compliant because that can create disproportionate value. Some are being forced to do so by consumers like EVs, right? And I think market forces will sort of drive that. So I would say entire business model rewiring that needs to happen and capital that needs for that to be executed are probably the two most biggest challenges that we need to think about.
Sure. So Rishi, you have seen multiple markets, global markets, and your company is your brand owners in multiple markets. And how do you see the ESG construct change market to market? And where would you peg India? While we all understand we are on the cusp of change, and two, if there were any learnings that India is better off in, what are those?
Yeah, let me start with the second part of the question, right? So we recently had majority stake change in our company, right? And we got one of the 3 global bluers to now own a major part of the company. And that company, Heineken, has made a lot of public commitments on brewing a better world. And as part of the brewing a better world in terms of what's the kind of impact it has on governance, how they are transparent about all these metrics that are going to get measured, how they will engage with communities and how they build, let's say, responsible consumption of alcohol, right? And as part of that, when they started benchmarking vis-a-vis the Indian operations, whether it was water usage, which I think in India for brewing, I was pleasantly surprised is globally competitive and compares with the best that there is in the industry, right? If I look at our usage of thermal energy, it's almost 95%. If I look at electrical energy coming from sustainable sources, it's close to 40%. If I look at our packaging, it's not just potentially recyclable, but is actually being recycled in the form of glass or aluminum, right? So if you really look at all of these, I thought that it was not all doom or gloom, right? Whether you look at the product, you look at the conversion, you look at energy usage. So I thought that gave us a lot of confidence that we were in a position where sure we needed to improve, but the starting point was not all black, right? And I think there is a, to go back to the first part of your question, there is a, brew a better world strategy. And the fundamentals across countries are the same. How do you use raw materials in the most efficient way possible? How do you ensure that you get consumers a choice of a combination of good for you products and, give them a zero alcohol choice? So I think those fundamentals are the same. Different countries are in different stages of evolution, but we were not completely de-energized looking at where India was. In fact, it gave us a lot of confidence that given time, the right resources, the right technology, we could be the best of the best.
Thank you. Nalin, just to bring you in from, again, the global versus domestic investor perspective. I mean, your earlier point about that the retail investors are not showing so much of great haste in getting into the ESG funds, but the institutional investment sides have started moving along there. What are some of the global investors' concern about ESG India?
So the biggest area of concern is on the environment, on water usage, on energy usage, like Rishi mentioned, on emissions and things like that. Social matters are perhaps the least concerned, and governance, of course, is a deal breaker for people. But the biggest area of focus is on the environment.
So the last question before we throw it to the audience, Shruti, I'll come to you. Regulations versus spirit of regulations. I mean, the regulators come with a bunch of regulations, and smart lawyers come with a bunch of tick marks. What do you do? Where do you actually move away from just regulation to actually following the spirit of regulation?
So, to my mind, I perhaps look at the regulatory environment for ESG slightly differently. I think, most regulators across the world, definitely SEBI, is likely to leave it to the spirit of things only. I doubt you will be in a situation where any regulator globally is going to get prescriptive about what they want to find, what they don't want to find. It is likely to be a scenario where they will lay out the land in terms of what is the principle based on which they would want to see reports put out there. We should also be clear that unlike, say, credit rating agencies, where, and a lot of them are perhaps facing problems today largely because the reports are concerning a material event that can lead to a plummeting of a stock at a particular point, right? ESG has a various set of softer factors that may not have such a sudden big impact, 90% of the time, can't have such a sudden, kind of a death knell on a stock, and perhaps the regulator is going to keep that in mind when they get a little more principle-based about this. So I think the answer to your question is it's not tick the box, but it'll definitely be the spirit of the law alone.
Thank you. So now we'll open it to the audience if there are any questions. I think we've covered all the topics from ESG perspective, right from compliance to culture to values to behavior. Can somebody get a mic, please?
So, I think ESG compliant companies mostly, I understand, are in the large cap companies, and the investors who wanted the growth in their capital appreciations would look for the mid cap and other cap companies. So if he is investing in the ESG companies, he's restricted his growth opportunity. Do you think so?
Naren, would you want to take this one?
So that is a misnomer, sir, for two reasons. One, I can think of many small and mid-cap companies in the listed space that have fantastic ESG scores. And I can also think of some of the largest corporate frauds and ESG disasters that have happened in the last 10, 15 years that have happened in top 100 companies. And I won't take names, but I think people know some of the incidents that I'm talking about. So it's not the case. It really is company by company specific.
Any other questions? Great. So thank you so much. Lovely discussions. Thanks to each of my panelists, and we'll hand back to you.
Thank you to the Honorable Moderator, Srinath. Thank you for moderating this session. I'd request you to kindly present the esteemed speakers of this panel, mementos. On our behalf, Srinath, please present them with mementos. And of course, I would also like to say thank you to you on behalf of the Mint India Investment Summit and Awards. As Ankur Thadani just said, that ESG standards are something that we cannot wait for anymore. The world can't wait many more years for them. This bomb is ticking and nature has lost her patience with us. As they pose for this happy photograph, I'd like to remind you all that we definitely want you all to join us for cocktails and dinner this evening. Thank you. Thank you to all the esteemed speakers, and thank you once again, Srinath, for moderating. I'd also like to remind you all to join us tomorrow for day 2 of the event. We have a session on green economy, which kind of follows up this session. We also have a session, India, $1 billion PEVC, and many more interesting sessions lined up for you all tomorrow. Registrations will start at 9:30 a.m. and the first session will begin at 11 a.m. sharp. So please do join us tomorrow and gather more wonderful insights. Ladies and gentlemen, please settle down, take your seats. I'd once again urge you all to continue posting using the hashtag MintIIS2022, and you can tag us at LiveMint. Once again, a huge shout out to our partners, presenting sponsor Trilegal and powered by sponsor MobiQuick. And before we move on to the next session, here is an interesting factoid for you, the Great Tech Wave. Here it comes. Once again, ladies and gentlemen, please settle down, take your seats. And a topic like this deserves all of you to be seated and give it a full house, please. Ladies and gentlemen, the third panel of the day puts the spotlight on the great tech wave. When pandemics sweep through societies, they upend critical structures such as health systems and medical treatments, economic life, socio-economic class structures, race relations, fundamental institutional arrangements, communities, and everyday family life too. A new canvassing of experts in technology was asked to consider what life would be like in 2025 in the wake of the outbreak of the global pandemic, and some 915 innovators, developers, business and policy leaders, researchers and activists responded. Their broad and nearly universal view is that people's relationship with technology will deepen as larger segments of the population will come to rely more on digital connections for work, education, healthcare, daily commercial transactions, and essential social interactions. An expert, ladies and gentlemen, described this new world as a tele-everything world. In India too, the pandemic has resulted in complete and overall tech adoption across the country in all spheres of life and work. This has brought in tens of billions of dollars into Indian tech startups. Equally, corporate groups have been busy building or acquiring tech capabilities as they look at ways to transition their old world businesses into the new tech age. We gather the best minds of the startup world, PEVC ecosystem, and corporate India to decipher and predict where the technology wave is headed. But before I invite the speakers on the dais, I have my signal coming up for a 5-minute break that the audience has, as you can see, forced us to take. So I'm on standby mode as I wait for my audience to come back for this very important session of the day. Even if the most wonderful man in the world asked a lady, tea, coffee, or me, she'd definitely say tea or coffee, not me. This is what the audience has just done. Yes, of course, please get yourselves tea and coffee and just please come right back into your seats. Ouch. Ladies and gentlemen, please settle down, take your seats. We're about to begin the next panel. Those are the loudest bells I've ever heard. Not having the desired impact, though. Did you also step out for a cup of tea and coffee? You did? But you came back as early as you could. Thank you. It's a challenge to get, so okay. So it's a disclaimer you're telling me, कि आपने देर नहीं करी. Disclaimer. the hotel hospitality staff isn't going to be happy that I'm saying it on the mic. Please settle down, everybody. Our speakers are waiting. The moderator is waiting. Before I even introduce this next session, I want to ask you all, did we give you a break? No, we didn't. I think I've been on stage for many, many years, and I've conducted many, many such conferences. This is the first time I've actually seen an audience decide that they want a break and just walk out and take it. We should change that quotation that consumer is king to audience is king from here on. And queen, of course. That bell is going to break, but they ain't coming back. Do I have permission from the organizers to start introducing this next panel? The check comes from there. You're all, okay, then the check comes from here. Then I'll go for it. Thank you. Ladies and gentlemen, welcome back from a break we didn't give you. The third panel of the day puts the spotlight on the great tech wave. When pandemics sweep through societies, they upend critical structures such as health systems and medical treatments, economic life, socio-economic class structures, race relations, fundamental institutional arrangements, communities, and everyday family life. A new canvassing of experts in technology was asked to consider what life will be like in 2025 in the wake of the outbreak of the global pandemic, and some 915 innovators, developers, business and policy leaders, researchers, and activists responded. Their broad and nearly universal view is that people's relationship with technology will deepen as larger segments of the population will come to rely more on digital connections for work, education, healthcare, daily commercial transactions, and essential social interactions. An expert described this new world as a tele-everything world. In India, too, the pandemic has resulted in complete and overall tech adoption across the country in all spheres of life and work, and this has brought in tens of billions of dollars into Indian tech startups. Equally, corporate groups have been busy building or acquiring tech capabilities as they look at ways to transition their old world businesses into the new tech age. We gather the best minds of the startup world, PE/VC ecosystem, and corporate India to decipher and predict where the technology wave is headed. I'd like to invite on the dais the speakers of this session: Vikas Agnihotri, Operating Partner, SoftBank Investment Advisors. Thank you for waiting. Naveen Tiwari, Founder and CEO, InMobi Group, joining us virtually. Put your hands together, everybody. You made them wait. Shweta Bhatia, Partner and Head of Technology Investments, 8 Roads Ventures, India. Kasturi Ghosh, Partner, Try Legal. Priyanka Gill, Co-Founder, Good Glam Group, joining us virtually. Varsha Tagare, Managing Director, Qualcomm Ventures. I'd also like to invite on stage the moderator of this session, Leslie Demont, Executive Editor, VC Circle. Over to you, sir.
Hi, Naveen. Hi, Priyanka. Yeah, okay, we can see them now. Okay, great. Folks, you know, I would have liked to start with an introduction, but I guess we are already running out of time. And we have had, as you must have already noticed, we have on this panel 2 founders of unicorns, that's InMobi and the Good Glam Group. We have 3 prominent investors and a very sharp legal mind in Trilegal. So the context for this panel has already been set throughout the day. We have had a lot of discussions that tech adoption has been accelerated because of the pandemic. And now we are seeing that, I was looking at this ICVA EY report, which says that the tech sector alone saw something like $16.3 billion invested in it. And in the e-commerce sector, it was something like $15.9 billion. I think between the tech sector and e-commerce sector, it's almost, they account for 42% of all investments in 2021. Of course, you are looking at the overall thing of that $71 billion kind of figure in PE and VC investments. And then you say that, okay, it's no wonder, it's no surprise, basically, that India is the third largest ecosystem, startup ecosystem globally. We already have about more than 80 unicorns. I think 84 is the number that Vikas, when I was talking to him. We have 22 the last that I remember when VC Circle put out the number, it was 22 Sunicons. So Sunicons are basically startups with $500 million, the valuation more than $500 million, but little less than $1 billion. And of course, then there are these minicons that I heard about. So we have minicons, we have, I can see Naveen smiling. So a long way, minicons, Sunicons, unicorns, then you have the decacons and the hectacons, and I do not know where it's going to.
You'll have con reggae.
Exactly. So it's a very interesting space out there. And I think, yeah, the momentum is still continuing because in the last 3 months, we have already seen about 10 unicorns, the emergence of almost 10 unicorns, if I have my numbers right. Will this momentum continue? Are we going to see, because companies are still investing in Web 3.0 technologies, whether it's blockchain, cryptocurrency, non-fungible tokens, the NFTs. So there is a lot of bullishness. But how long will this bullishness last? Because there's already a shadow over the valuations. When companies hit the stock markets, which we have seen over a period of time, the valuations recently almost halved. So we saw among the different, I think, 40-odd IPOs that we had, new age, there were about 8 or 10 new age tech IPOs, out of which I think about 6 or 7 already you saw their valuations almost half on the bourses. Now that was a little disconcerting. The second part is that losses and cash burns are still an issue in this sector. The third part is we do not know when the pandemic is going to become an endemic. We are not too sure. And then, of course, you have the Russian-Ukraine war, which is another cause for concern as of now. But yet, I'm seeing in my talks, just when we were just huddling together, I realized that there is a lot of bullishness, a lot of investor confidence that I'm seeing, which is very good for the minicons and the sunicons, and of course, the unicorns that are already there. And instead of, where is this going to be heading? Let's rather, instead of trying to speculate, let's directly jump into and just ask the first unicorn in the country, and that happens to be InMobi. So Naveen, could you tell us, what do you make, where do you see 2022 in the light of the kind of happenings that are going on? You're seeing investor confidence, you're seeing your own company, you have 2 unicorns under your belt, InMobi and Glance, and it looks like there's no stopping you at this point in time. So what's your sense on the sector?
First of all, thank you for inviting me. It's great to be here. And secondly, I just want to apologize to all the audience because I think we ended up forcing you guys to come back from your great chai break, which I think would have been more exciting than this. So apologies for that. Look, I think the great tech wave is absolutely real in the sense that the world around us is changing. Every one of our consumptions and our consumerism, the way we deal with life is changed, and it's certainly changed in the last 2 years or so. So I think the fact that there is a big tech wave, that's absolutely true. In any of these big technology sectors, and when the world has to change, the change is always led with a lot of exuberance because that's the only way change can be brought about. And if it's not, then the change doesn't really happen. In that exuberance, things will go up and down. There will not be, there will not be any consistency or there will not be any predictability. Because if it were, then the change is not real. It's not going to be, dramatic. So
one can actually feel a bit of pain about what's really happening in a short period of time. The sector goes up, sector goes down. But if you take a slightly longer term view to the world, 3 to 4 year view, every one of our lives are much better. So in fact, if you go back 2015 and look at 2022, 7 years, the world's changed a lot. Whether you talk about digital payments, you talk about media consumption, you talk about transportation, you pick your sector that you want to pick, and you will see that the world has changed for us. And so that's pretty much what we would look for. Now, when it comes to India, I think it's phenomenal because digital as an infrastructure is an easier one for us to essentially go after, especially for a lot of middle class aspirants, people, entrepreneurs who really want to do things and change the world. They can actually do so. So therefore, it's a great leveler, as I would call it. So we may not be the third largest economy in the world, but we do have the third largest number of companies out there. So that clearly calls for what our impact to the world is actually there, and we are actually making it. We are punching way above our weight from a market point of view, and that's the reality, and that's great. I think what's really happening today is you have businesses or technologies that are actually changing the way our consumption is. Our lives are changing. The business model is not yet there. The business model is lagging in most of the cases, and that's why you see the public markets react pretty extremely to some of these things, because these are new business models. The losses will be high, they will not be predictable at times, but eventually, after some of the whiff and wap here and there, you will see businesses really become large. Now, the only challenge that I do see from an India perspective is not the fact that we'll create another few hundred unicorns, maybe do like 1,000 unicorns in the next 4 or 5 years, but the challenge that I do see in this is the fact that India in itself as a market may be a little hard to sustain the bigness of the market in its true sense. So we may have to look at Indian companies actually building global platforms and global businesses, as against just only focusing on India in a short period to mid period of time. Over a longer period of time, as our GDP per capita goes up to, call it 4,000 to 5,000, we may have a far better sustainable businesses of our own. So that's at least how I think of it. But overall, of course, I remain very excited about where things are.
Thanks, Naveen. I think you already jumped into the challenges part of it, which I thought I would come to a little bit later. I was talking more about the kind of opportunities that we had at this point in time, but I'm glad you brought that up. But you made an interesting point on the business models. So in that particular context, Priyanka, you have a very interesting business model, which is D2C house of brands kind of model, the Thrasio-like kind of model, which people are very familiar with. Is that because you have this kind of niche that is making it work in this sector? And how do you look at this, the entire 2022?
Hi, Leslie. Thanks for that. And I think if Naveen was the first, we were the 35th, if you're keeping tally of where we come on the unicorn, on the unicorn ladder. So look, our business model, as you called it, is a house of brands for sure, but we're actually very different from a Thrasio play. Thrasio is a roll-up model where they look at kind of, I imagine they look at acquiring companies where there's some economies of scale at play, and then they kind of apply those and they scale the companies up. At the Goodlam Group, we look at a content creator and commerce model in which we look at content companies being the top of the funnel for us. So within the group, we have some of the largest digital media properties in the country: PopXO, Scoop, Miss Malini, Baby Chakra. So all of them give us 150 million users, which we then drive down to the beauty and personal care brands that the group owns, right? And this gives us a very, very unique funnel at which we don't need to spend marketing dollars to convert content consumers who are influenced by creators and make them into purchasers and buyers. Because of this, of course, it increases revenue, and it also increases, and it gets us to EBITDA break even, right? Which is amazing at our scale. So it's a different model. We look at economies, we look at content creator and commerce, and that's a fund we're building out at. I think this great tech wave has enabled companies like ours to come forward and build, to Naveen's point, India first solutions that are also India-led solutions that are a world first, right? And something like this has not really been seen at scale, even at a global level. So the markets need to be large enough for us to sustain. And at the Goodlam Group, of course, we are an Indian group right now. but we are looking to global markets to see where else we can take this innovation forward. So definitely, all of us are waiting with bated breath for per capita in India to increase. Until that happens, I think it's time for Indian companies to take kind of the innovation wave forward and expand not only our ambitions, but also the markets that we play in.
Thank you, Priyanka. So, Vikas, let me come to you. I mean, from a SoftBank perspective, of course, you all were the first to have shown confidence in InMobi. I think it was $200 million that I recollect. That was still Geo put in another as big a sum in InMobi. But other than that, SoftBank has invested over, what, $14 billion over most of it in the last 5 years. And I think last year it was $3 billion. Over $3 billion. And you have already, what, 17 startups?
Oh, no, last year was over $3 billion. We did 17 investments, 11 new and 6 follow-ons.
So clearly you're very, very bullish in the sector, and as I said, that this momentum will continue. So could you tell us what exactly are you seeing that probably others are not seeing it as clearly?
Okay, Leslie, first I'm just going to digress a little bit. I just want to thank you and Mint. Also because this is the second time, frankly, in my professional life, I'm on a panel which has, off panel of 6, it has 4 women. And I think it's just an amazing thing. I think we should have more panels of that nature. And it just goes, as I said, I mean, this is the second time in my professional life I've come on a panel discussion where, so hats off to all of you. I really wanted to say that. In terms of SoftBank, I think if you generally, I think Naveen also touched upon it, but if you generally look at, and this is actually from my previous company days, when we started looking at the digital transformation and the internet adoption that was happening in the country. So there are a whole lot of features that actually continue. You have a country with a GDP that's actually growing 6, 7, whatever that number keeps fluctuating, but it is still one of the fastest growing economies. It is expected to become the 3rd largest by 2030. By 2025 or 2026, give or take a year or so, in a $5 billion economy, $1 trillion is supposed to come out from digital economy. You actually have an amazing confluence of what I at least call 3 things which are going for this, for whatever is happening right here. One is that you have a very young working population. Second, you have a lot of, actually pretty much maybe 60, 70% of all of them who are actually connected. So you can actually reach them through digital and through the internet and digital means. And third, you actually have, as I said, in terms of the per capita GDP that's growing. And I think you heard about that fact that it follows kind of an S curve where once the GDP per capita goes from $2,200, $2,000 up to a $4,200 limit to a level, your consumption, especially, if I was to speak in terms of the good glam category, your actually consumption of goods goes almost 2x times the country's growth rate, right? So it's actually a fantastic time because, people will consume more, they will buy more, they will buy better stuff, and it plateaus out when it reaches about 4,200 to 4,400 in terms of how much more can you eat and how much better can you eat, et cetera, et cetera. So we actually have an amazing next 5-10 years where you will see massive growth. Also, India is a consumption-driven growth, right? Consumption-driven story. We slowed down in COVID, a little bit of consumption slowed down, but consumption is actually back. So if you look at a bunch of these factors for India, it favors actual growth that's going to come out from this part of the world. Also, when you look at how easy the Indians have adopted to technology. And it's something that, as I said, I saw it when I joined Google in 2011, we were not even 100 million people on the internet, right? And the transformation came rapid fast from 2013 onwards. Device prices became cheaper, the data prices came down, and we are amongst the highest users in terms of the content, in terms of per capita GB usage that happens on mobile data, right? So all of that is actually telling you that
consumers are adopting to technology, in fact, sometimes faster than marketeers are. And with time, as technology is becoming intuitively simple, whether it is in fintech, whether it's in agri-tech, whether it's in ed-tech, you are having a lot more adoption that's happening. The other three big things which we think get us to focus a lot into India is really in terms of when you organize the unorganized, there is an opportunity. India is full of the unorganized. And that itself was a strength at a point of time, but now the strength is when you unorganize the organized. Second and third, I'll combine it. If you look at education and healthcare, with the number of schools and teachers that we have and the number of doctors that we have, frankly, tech is the only solution. That is the only way you will have both healthcare and education being solved, and it will not happen by physical infrastructure. It will happen through a tech medium. I can actually go on because there's so much of excitement that we see in terms of early indicators and indicators that continue to remain true. And that is the reason why we are very, very optimistic in terms of the opportunity here. By the way, I must add, in this country, the adoption of video, it has been phenomenal. And again, if you look at video, it breaks the education barrier as well as the language barrier. And India, we must appreciate, is not one language consumer behavior, it's multiple languages. So video is actually a platform that's becoming richer and able to convey and get more audiences for marketers to reach out to. So as I said, there's a lot that's really happening here.
Thanks, Vikas. In fact, when you listen to these numbers from Vikas, you should know that it's an ex-Googler also speaking about it. So all those numbers on video that he's rattled about, the internet numbers, spent a lot of years in Google, and that's exactly what he brings to the table out here. But very interesting, and I like that you pointed out the fact that there are quite a few women on this table, including engineers and computer scientists also out here. In fact, Varsha has 2 microprocessor patents on her name. So please give her a big hand. Yeah. Shweta, very interestingly, the kind of companies that Eight Roads, you have been with Goldman Sachs, you have been with Warburg Pincus, and then now with Eight Roads. Pretty interesting journey that you have been through, and the kind of companies that Eight Roads also has invested, like Jiffy, a no-code automation company, Whatfix, a SaaS company. So you have looked at all these newer areas. So is it that when you are investing, are you just looking at the rationale on the bullishness continues on these deep tech companies because the danger sometimes is that these are kind of shiny objects that people don't really understand. So what's your perspective on this?
Yeah, Leslie, thanks for having me here. I think the first thing I'd say is that India for the world sort of software is something we are more bullish on than we've ever been before, right? And there are several reasons for it, right? And it's taken a while for this to happen, but we are finally at a point in the country now where software products built in India are increasingly becoming category leaders globally, right? So if you take iCertis, Whatfix, Quizzes, etc. There are multiple such examples of Indian software products that have done that, right? And secondly, I'd say our right to win in global SaaS is only getting stronger because we have a very large developer base, which is, again, with 400K engineers coming out of college every year, it's becoming bigger. And when you look at sort of newer areas like developer tools, or you look at vertical software, which is going after different industry, we really have the benefit of these 3 million software developers who use these developer tools, so we can come up with products that are first evangelized in India and then are used globally. And the second thing I'd say is the IT services heritage means we have gone into various industries globally just very, very deeply, whether it's financial services or retail. So as it comes to vertical SaaS, we're actually in a pretty good position to disrupt it globally, right? And own these sort of new SaaS companies that'll come out. And then finally, I'd say that, when it comes to GTM, the big challenge used to be, okay, but your product's in India and you have to sell to these large enterprises in the US and Europe. Like SMB selling was easy because you could do remote selling for that. But increasingly what we're seeing is, A, the founders have figured out the right combination of remote and overseas selling. So their playbook on GTM is really working out. And secondly, with the pandemic, everybody is just globally more comfortable with remote implementation, remote customer service, all of those things, right? And the final thing I'd say is, look, we have a big benefit on the customer support side as well, which is, again, becoming a really important driver for enterprises to pick a SaaS provider, and India really shines there, right? So given these various reasons, we believe we've just scratched the surface. We're at about 1% share of the global SaaS revenues in the world, and we're at about sort of $3 billion, and we believe, in the next 5 years, it's not difficult to see this 1 billion go to 15 billion and the 15 go to 50 in 10 years, right? So there's a lot of, forget valuations, there's just a lot of revenue to be created, and then the valuations can follow.
Yeah. Varsha, I think you also have a similar experience, because I think you have invested in companies like Zadil, MapMyIndia, and all the kind of deep tech companies that we're talking about, given your own engineering background and all that kind of stuff. And of course, since it's Qualcomm Ventures also, probably that also lends itself to that thinking. But what are the kind of things, are you seeing this, like as he said, the market is pretty big enough. What are your thoughts on that?
We're a very focused investor in deep tech. So we invest in areas of 5G, AI, IoT, auto, and cloud. And as you see, the overlying theme here is what is the new technology coming to market. And so we think 5G will enable a lot of these use cases. We also think 5G will enable machines to be intelligent, not just humans. We saw humans getting a lot of benefit on 3G and 4G, but starting with 5G, there'll be a lot of opportunities in machine. So what does that imply? Even in India, we see huge amount of opportunity in robotics and drones, or even wearables. Companies, some in our portfolio and some in our colleagues' portfolio. So we saw Boat, which has become a large player in India, as well as for the globe, creating wearables from India. I mean, who would have thought a few years ago would not have been possible? Drones are now being made in India. A company called IdeaForge does that, and Army is buying them. I mean, government is buying drones from Indian companies. That's a huge change from what we saw before. And all of us suffer from labor shortage. We all now want, the iRobot at home, or we want a washing machine at home. So I think that's what will drive opportunity in very intelligent machines that will serve your home, that will serve the enterprise, and that will serve the government. And hence, we are very bullish on the overall area. The other thing we see is new opportunities in auto. That's a new frontier. Think about your car or our two-wheeler in India getting really, really smart about what it does. It learns about us, or predictive maintenance. I don't know if you guys saw the Chetak from Bajaj, and it talks about new capabilities that the EV enables. So we're very bullish, and that's a new wave of technology that will be here. So overall in deep tech, we see opportunities across vertical areas. We also think highly about the SaaS area that Shweta already mentioned. So among all of those, you have 4 or 5 mega trends from technology. And you'll see large companies that will be being built here. Navin pointed out about consumers. I think consumers got impatient in COVID, and they drove high expectations from all companies. A simple example is your delivery happening on time. If that delivery didn't happen on time, you lost the business. And so we saw huge innovation in logistics. One of our building block company, MapMyIndia, went public in December. It provides really the toolkit for mapping in India. So consumers drove that innovation. And so you will continue to see a lot of innovation in logistics sector as well in India. We see the 2 folks here on virtual conference. I think it'll be nice to see them in a better atmosphere.
Yeah, we would have wished them also.
Qualcomm is very bullish about what we call the metaverse. We think it's very difficult to have a hybrid environment which is not as engaging for the audience as well as the participants. So at Qualcomm, we are investing very heavily in what you may think about as Star Trek equipment, but it will make your life much more engaging and enriching. And not just in a consumer experience, but think about in a factory environment where you're trying to repair machines, or in a healthcare environment. So very excited about what Metaverse brings to that. The other vertical area that Metaverse will enable is gaming. We saw lots of opportunities in gaming in India, and you think about that, the next wave, it'll be very, very enriching. So we are very excited about these areas, Leslie.
Yeah, thank you, Asha, because I think you got a lot of these clear, the cutting edge kind of investments that you have made, right from the metaverse. And of course, I mean, I mentioned earlier also a lot of look at the Web 3.0 kind of companies, whether it's cryptocurrencies, blockchain, NFTs, despite the fact that there's a lot of uncertainty about the regulation. And in fact, just talking about the unicorns, I think when Naveen's InMobi had become a unicorn, I don't recall even people talking about the company. Yes, Naveen did point it out to me, so I can see him smiling about it. But I'm glad there's so much more excitement this time around. But talking about the regulatory uncertainty about certain things, I come to the lawyer in this team who handles the M&As, the corporate advisory, and of course, he's an advisor to many tech startups about. Now, I remember in 2020 on one of the panels, you did speak about the perfect storm with the funding boom. Again, 2021 was an amazing year. We have just reeled out all the numbers out here. 2022, there's some skepticism. All as investors, obviously, you have to be bullish about it. Startups have to be bullish about it. What's your take on this?
So let me be the skeptic in the room at all times.
We love skeptics.
So, no, I think, you know, the fact of the matter is the companies have grown. Money has followed, right? Whether I say it or I don't say it, that is the reality of the day. But I always caution against, you know, the fact that there is a lot of money, there is capital, but is it following the right path, right? So ultimately, the valuations are only one side of the game. But are you finding the companies that truly believe in creating trust? Because a lot of what we speak about is ultimately, you know, when it reaches the consumer, it is about the data of the consumer, right? So when you put the privacy aspect at the heart of it, then you know, we would want to have tech startups or unicorns who believe in that as being the central ethos. Right, so that's where, as a lawyer, I feel that, you know, we have to spend a little bit more time actually trying to drill down, both from the side of the investors as well as the founders, to kind of, you know, to say the business model is great, but, you know, but what else? Right, so I feel that, you know, as a lawyer, we have to play that role a little bit to check and to, you know, to ask these tough questions at times, and many times, you know, it sets off a spark, right? So I think there's certainly a lot that we need to think about in terms of law trying to catch up. So if you talk about blockchain, you talk about the crypto side. Yes, everybody is in a gray zone, and people are able to operate because they are kind of saying, okay, you know, we'll see, we'll take it as it comes. So I had an incident the other day when a client called me and they said, you know, we'd like to do something in the metaverse with an NFT and crypto. And I said, you've just thrown three things at me in one sentence. You've not taken a pause. Do you really know what you want to do? And he said, okay, I'm going to write up the brief and then I'm going to come back to you. But he said, I want to be the first to do it, right? So that is driving the behavior of the companies. So ultimately, it's for us to put a little bit of that pause and to say, you know, what is the goal? What is the objective? How do you want to really get to it? Because ultimately, a valuation doesn't just come from numbers. It comes from, like you were saying, from sales. And how do you build sales? By building the confidence of the consumer.
Yeah. I think you brought up a very interesting point, because typically when solutions are created, especially in the technology company, we always say that first they create the solutions and then look out for problems. So I think that is something that you as investors know where to put your money in. So that I think you all have mastered that art specifically. But then of course we have also been talking about 7 out of 10 startups dying. Does that continue? Naveen, in your case particularly, I know that you also encourage a lot of entrepreneurs within the company, the boomerang program that you call it, if I remember the name, if I recollect the name rightly. And what is your advice to the minicons, the sunicons who are trying to, you know, who look up to companies like yours and want to become the next InMobi, the next unicorns kind of stuff?
Yeah, that's a great question, Leslie. I think behind all of the hype, there are certain hard realities of building a business. And there are 3 points I want to make on this. I think one is, like, for all the top-down things that we'll talk about, the trends we'll talk about, that's all good because that's required, because that's the wind behind it. It requires hardcore fundamental execution to build a company, and that is not as clean, as sexy as it seems. It is all about doing the plumbing. It is about doing the dirty work, and it's about making sure that that thing really works and the service reaches the end consumer. And I think in a lot of the conversation, that piece gets missed out. The glamour of doing the plumbing is actually missing in our narrative today, and that is very important for us to do. So I think that's point one. I think point two is partly linked to the first point I did mention is I would say Indians and Indian entrepreneurs should build software that should rule the world and build from India. India is a great market, in my view, to test products, to build products that you can actually, test out. Unfortunately, the unit economics of the market does not support you to build a very highly profitable, scalable businesses that can compete with the global businesses, because their P&Ls would look very different from yours. So you cannot sit there and say, well, it is okay for my P&L not to look that good, and therefore I'm going to just do that. So I think a lot of people did mention this, but building for the globe. So Shweta was talking about how we need to build the SaaS businesses sitting out of India. It's a big thesis, because we truly understand how to sell to enterprise customers globally, and we can actually build great software sitting here. Similarly, we are amazing engineers when it comes to the newer technologies, because we read fast and we learn fast. So whether it's artificial intelligence, whether it's blockchain technologies, writing software has become far easier. And over the last 10 years, our own utilization of consumer services or enterprise services are very similar to what is getting used in the world. For example, my kids, when they go to the US, they do not talk about, oh, I've never seen this before. They have seen everything. They have seen every content. They have seen every program, every brand, everything. So nothing is new for them. And that's a very different world than what you and I grew up in, and what our kids are growing up in. So therefore, the gap in understanding of the consumer, whether it's enterprise or end user, is far lower. And therefore, you will see a lot of not just software platforms that Shweta talked about, but also consumer platforms coming out of Asia, because your cost of getting to 100 million users is far lower than the cost of getting to 20 million users in a developed market. And ability to build something for 100 million users and perfect it and then take it out is phenomenal. We have done that with Glance right now. We've done that with 2 other platforms, and the big examples of TikTok, etc., are very well known.
Naveen, I'll just come back to you because I think we're running out of time. Priyanka, very quickly, your bits of advice, 2 pieces of advice for the minicons, the sunicons, the budding entrepreneurs.
Build for value, right? And it's all very sexy to talk about the big funding numbers and all of that. And if you're not building for value, you're not going to survive in the very long run. So find where value is and build for that. Second is just keep a really tight eye on your numbers, right? Right now, there was a time, some time ago, when funding was really open, and now funding is getting a little bit kind of slightly choked because of what's happening in the globe. So really kind of build for value and keep a tight eye on your numbers and make sure that you know exactly what you're doing, and don't get carried away by all these conferences that you're kind of all of us are saying and you're talking great things. Just really keep your head down and build for value.
5 minutes. Yeah. Thank you, Priyanka. A very quick round. Let's start with Shweta. 1 piece of advice from an investor point of view.
I think very similar to what Priyanka is saying, right? I think entrepreneurs, what we see is there's this dichotomy a little bit, right? Like on one hand, investors like us will value category leadership, breakout growth, all of those things, right? And then on the other side, you have to work on sustainable metrics, right? And those two always don't go head to head, right? So you're trying to be the clear leader so that you can get this disproportionate valuation and create disproportionate value. But at the same time, if the market turns and you haven't really figured out your metrics, you could be in a tough spot. Now, there's no easy answer, but I think it's a fine balance for entrepreneurs to strike. And just given, I mean, you were talking about, right, the correction in valuations, et cetera. We're not seeing any of that really show up in the private markets yet, or at least in the earlier stages in which we work in. And there's still enough dry powder, a lot of excitement about these fundamentals, but, right, even more important to strike this balance, I would say.
Vikas, very quickly, one line, time's up.
Okay, we are kind of late-stage investors, so we are generally backing teams that are proven, founders that are proven, because we are not early stage. But some of the thesis doesn't really change, though some metrics change from a B2B to a B2C. But I think we love seeing founders and teams that are obsessed with the product, because product always wins over a period of time. We love founders who are obsessed with the consumer. I think product and consumers totally at the heart of everything, as well as the fact that they understand a business model. They don't think that acquiring customers and somewhere eventually it'll start making a business sense. Overall, I think I'll take 30 seconds, but overall from the way Masa and Rajiv actually think, we like to invest behind where we find that founders are trying to solve a big problem. Technology will provide the solution and the impact is going to be big. And then it's going to become, then it'll be scalable. So those are the few things that we look at, but yeah.
Varsha, SoftBank has the advantage of coming a little later, but you come in earlier. So your advice?
No, we are very thesis driven. So if you are in the area of our thesis, please come and see us. I know you're running short on time, so I'll be very quick on that.
That was really short and sweet. Thank you. The last legal word.
I think the point that Naveen was making on fixing the plumbing, I don't think he meant the compliance side of things, but let me use his words to say that compliance is an important part. So when you're growing, don't just keep that at the back of your head. Work on it, because these guys are certainly going to ask you questions around that.
So becoming a unicorn is a very exciting journey, but plumbing has to be done in the right manner to be on stage and have investors such as SoftBank, 8roads, Qualcomm Ventures, etc. back you up. Let's get our act together. Let's move on from minicorns, unicorns to the unicorns. And thank you, everybody, for this, for making time from your hectic schedules. Please give them a big hand.
Thank you. Leslie, I always told everyone, it's all in the plumbing. Let's thank our esteemed speakers, please. I'd request you to please present them with mementos, a token of our gratitude. And thank you, Leslie, for moderating this session. Thank you very, very much, all of you, for taking the time out and participating in this panel. And while they pose for a group photograph, let me quickly head into the next session. Ladies and gentlemen, coming up next is a fireside chat. Opportunities in disinvestment and national asset monetization. Is the next session coming up? And thank you. Thank you very much. Thank you all. Ladies and gentlemen, as we head into the final quarter of a very, very difficult 2021, there were some silver linings we must talk about. If I were to point out some of the events on the policy-making front, I would unflinchingly select 3 events. Air India privatization, efforts towards the listing of the Life Insurance Corporation, and the national monetization policy. All 3 initiatives that can change the direction of this great nation. Let's dwell deeper. I'd like to invite on dais Gulveen Ullah, Senior Assistant Editor, Mint, who is now going to be in conversation with Shri Tuhin Kanta Pandey, Honorable Secretary, Department of Investment and Public Asset Management, Ministry of Finance, Government of India, who is joining us virtually. Namaskar, sir, and a very, very warm welcome to you.
Good evening, sir. Thank you so much for joining us. Ladies and gentlemen, we have the Secretary of Divestment and Public Asset Management, Mr. Tuhin Kanda Pandey, with us. From his busy schedule, he's managed to give us time. We're very thankful to him. So we very quickly will get into the whole discussion that we have today. The pandemic has changed a lot for everyone, including investors and the government. How has it changed the way the government does divestment and asset monetization?
I think, of course, we had several rounds of pandemic, as you know. In this very financial year, we had, right after the budget, Delta wave, second wave, and towards the end of the last quarter, we had Omicron, the third wave. So obviously, this impacted, like many other activities, strategic disinvestment particularly, because that's one where we require a lot of engagement with investors, which includes, due diligence process, even going to site inspections and a lot of due diligence work. Everything cannot be performed virtually. And I think even the advisors, etc., were also impacted while the waves were on. So to that extent, several of the transactions got delayed. But then, as soon as the waves, waned, they have been brought back on the rails. So we did have an impact, but it's not that we are not in this disinvestment track. We are back on the track.
So there is, of course, this big powerhouse that you're bringing to the markets, LIC. Everybody has their eyes on it. Is the government ready to go ahead, or are there any challenges that you're facing?
The government is ready to go ahead. Honorable Finance Minister also indicated earlier on, and as indicated by her, we brought in the DRHP on time, and we have also got, subject to certain observations, SEBI's go ahead also, and December financials that needs to be incorporated will also be incorporated in the addendum to DRHP. We are now watching the markets closely. As you know, we had these unanticipated events, which are of a very wide global nature. And this has impacted markets around the globe, including Indian market. LIC IPO is a large IPO. We wanted to go off well. Of course, there is a lot of enthusiasm. And in terms of the timings, we are watching the market closely, and we will surely bring it as soon as we feel that we will comfortably carry it on.
So how is the government handling the investor sentiment around the IPOs particularly? Because the challenges of crude and inflation seem to be getting more tedious. What's your view on that?
No, those are the important headwinds, no doubt, generally for the markets as well. The crude basket, the commodity prices. But at the same time, we have this IPO to do. And LIC is an organization which is also quite sound organization. And it's something which has been built over a period, and it has got excellent track record. So going forward, it will have a big future as well. So therefore, this is something which is not really directly impacted by the oil prices of things. But yes, generally, the market sentiments is impacted, and that's why we are closely watching as regards the timing.
So the Russia-Ukraine war is a surprise factor for divestment overall, not just for the IPO. What kind of feedback are you getting from investors? We have a whole room full of them here. What are the concerns that they are sharing for the overall strategy for the government?
There is something which is, you said investors generally or investors specifically for LIC IPO. At the moment, I think our engagement with the investors, potential investors for the LIC IPO has been going on. And this engagement has continued notwithstanding the crisis in Europe. It's very, very positive overall. We've engaged, the LIC management has been engaging relentlessly with investors around the globe. And people have shown keen interest in LIC, and they've tried to know and they've tried to analyze, they've fielding questions. There's tremendous amount of interest for the LIC. And of course, as you know that, this is a process, iterative process, which will a feedback loop, which will lead to ultimately our deciding on the timings and then moving forward. So I would say that so far as LIC is concerned, the mood is upbeat. Of course, there is a bit of headwinds in terms of people looking at Fed. Of course, we know that certain policy stance of Fed as well, but nevertheless, people are waiting for the mid-March meeting, and also people are also watching how the conflict unfolds, what are the likely impact. I think everyone is watching, and the market is taking care of that. We have also seen a certain amount of recovery in Indian markets last few days.
So geopolitical tensions are on the rise. We're all aware of it. But how does that affect the government's policy on privatization specifically, getting more private sector money into public sector PSUs, for both, not just for the ongoing privatization, but also for future prospects? Government has a separate policy on privatization completely. Where does that leave the government now?
I think that the policy of privatization is more stable because it's not, it's a little bit of a medium to long term. Because something, when we are saying changing of management control, it's not really so much with the vicissitudes of the market in general as it happens in share market sales in the market. Because that market goes up and down fairly quickly. In case of privatization, the transactions, they take a lot of time. The reason is that the government is exiting the management control. And when it happens, the organizations are gone into in great detail because the new investors or the acquirer will come into management. So they will look at the due diligence. The process itself is, it's an open competitive bidding process. It's not a process where we can actually pick and choose. It's, advertised, and then the people participate, and then we have an expression of interest. For example, today itself, we have received multiple expression of interest on HLL Life Care. This was actually announced some time back, and our advertisement, open advertisement had been issued. And today was the last date. And we have received a multiple expression of interest, and now it will move to the second stage. In the second stage, you go through the due diligence process, and then you negotiate we finalize the share purchase agreements, and then the bidding takes place. And finally, when the bidder is announced and it crosses the benchmark price, we call it reserve price, then we are able to announce the highest bidder. And then following which certain other approvals are taken. If open offer is involved in a listed company, that it's done as well, and the transaction concludes. So you can appreciate that this is actually any M&A transactions It's a slightly longish transaction. It takes about fair amount of time. And there the intent is to change the management control. And that I think is fundamentally far deeper reforms than the reform merely for listing and dilution of the stake sale. Because there the efficiency that we talk about, private sector efficiencies, the nimbleness, the capacity to respond to the situation, the capital infusion, bringing in new technology and management practices that we know that private sector is more capable of than the public sector. That comes into play. And that leads to greater economic and job potential of the organization than otherwise would have been possible. So therefore, those reforms are continuing as for the new PSC policy, which was announced in February 2021. And several of those transactions are on the table, and new pipeline will come as well. Of course, the timing will depend upon our capacity to handle the feasibility, the investor interest. And as we are able to, together as an ecosystem, able to conclude the transactions in a fairly acceptable way in terms of both investors as well as the government, there will be a greater momentum and greater acceptability to carry on more number of transactions. And we can actually then really, say that the government is trying to get out of business as much as possible, which is the intent of the new PSC policy.
So you've mentioned reforms. Now, for the private sector, for investors that would be participating in privatization, the key ask is always and has always been predictability and stability. What kind of a roadmap can the government provide to investors, to such investors, in the long term? Because that's what the government is looking at, long-term investor possibility into privatization.
I think that is extremely important. Because as I said that I think one of the main crux of privatization program is not merely to actually garner resources for the fiscal, because that can be even achieved in various other ways as well. This is a more difficult way of raising resources by way of privatization, because as I said that these transactions are fairly complex, long-term, and there are also legal challenges all the way in these transactions, which have to be also faced, they have to be encountered and they have to be handled. Be that as it may, these are basically aimed at, raising the economic and the job, generation potential of those enterprises. Because unless and until we use the capital, unless and until we also, increase manufacturing in India, unless and until we have productivity increase, unless and until we get into the newer and newer technologies, because the older technologies will go by the wayside. And that sort of decision-making, technology, infusion of capital, going to the market, bringing in best of the, new practices, that is the kind of momentum needs to be imparted to some of our organizations, which are no doubt good, but what we have to say is how far they can go ahead. That's the message for that privatization, and I think that is much more than merely raising resources.
But what about reforms for the government? You've mentioned capacity building. That is an area where the government would want to work more on so that more privatization can happen. What's the playbook for the government here?
I think you have said it rightly, that we need really capacity building of not only in DIPAM per se, but also in all the ministries, because we work as a team. It's not really an effort by one individual or one ministry. It is the whole of the government approach we have. And we have collegial processes and interministerial groups and others. So we require the capacity built up over, across the departments. If they're able to appreciate that how we can structure those transactions, how we can build up those transactions, which will be, for which it will be possible for us to go ahead. See, the employees are also extremely important because ultimately it is the employees which are another bedrock of every organization. And to that extent, they will get newer possibilities in their organization. They will get more enthused. And I think if they are able to watch some of the other organizations which have been privatized doing well, they would also, gauge the fact that, that some of the fears, which they might have, we would be able to sort of dispel those fears in terms of, job protection or things like that. Because ultimately, it's a sustainable employment which will remain. Beyond a point, nobody, not the government, nobody can actually, sustain an employment which is not sustained by the market forces, by the marketability of the products, by the profitability of the enterprises. Beyond a point, you cannot subsidize. It has to be, organization has to sustain on their own. They should be capable of running on their own. So therefore, it's extremely important that all these productive forces are unleashed if we have to grow and grow fast.
Great. So what about asset monetization? That is, again, one of the top priorities of the government, and that falls under your remit. Is government giving adequate incentives for investors and fund houses to be in India for the long term?
Again, I would say the asset monetization is again a whole of the government approach, not necessarily pertaining to my department. I think all of the departments have to come together, and that's how the national monetization plan was drawn up. Every department has chipped in, particularly roads and railways, powers, and you have food and public distribution in terms of the silos, airports, ports. The idea is to actually increase the capex. If we have a capex-driven, investment cycle as the core of our economic growth model currently, some of the role has to be played by monetization pipeline, because you can actually raise those resources upfront. If you want to create a number of roads, you can actually complete the roads in few stretches. You are able to, give tolling rights and other rights to the, it's basically in the asset monetization model, you're not really transferring ownership, but you transfer the rights. And once you give the rights, you can actually monetize those rights upfront and use that money to further increase the capex. So this is one way of raising money while investing the same amount of money. So it's not a, direct receipts to the government, but it is a very important impetus to the economy, where a lot of capex is taking place, where it is being generated from some of the investors who would be interested in, investing in InvITs, REITs, TOTs, or even, for example, PPPs. So these are the kind of structures, well-structured, transactions which constitute asset monetization of different kinds, where the possibility of investors to come in is there, which will help the raise resources, and those resources will help those organizations to build up further capital and put it in capital and create more assets. So that's the model I think many countries around the world are adopting, and India is no exception.
But so what about the targets? We have a good, healthy target of 88,000 crores for monetization for this year. How close do you think we are of achieving that?
I think it's likely to be achieved, because it may not be exactly in the proportion in which it was indicated that it will be done. Because some departments have, have gone ahead much faster. For example, I think to my understanding, about 17,000 crore has already been achieved by the Ministry of Road Transport and Highways in TOTs, in InvITs, as well as on securitization. And there are certain about 1,000 crore has also been done by Ministry of Surface Transport. Then there is the airport, the 1,400 crore of airport PPP has been done. And there is also something which has been done from the Food and Public Distribution Department. Something has been done from the railways. But a lot has been done by the mining, especially the coal department, where they have brought in MMD, the MDO model on a large scale. Apart from the mining blocks which have been auctioned, in the existing organizations also, the MDO, instead of directly investing, they are investing through MDO model, and where I think close to 50,000 crores worth of contracts have been awarded. So if you really look at it, everything put together, there is a good prospect of achieving the target. And of course, we have got a 1 lakh crore target for the next year, in which the different ministries have also to again start chipping in right from the beginning.
All right, so land monetization still remains a challenge. Of course, the National Land Monetization Corporation has been instituted, the cabinet has given an approval. But in your opinion, how well will this entity be able to navigate the challenges that are normally faced by any government department in monetizing land assets?
I think this is something which was needed, and because we really didn't have organizational capacity in any ministry in order to do that, because you know that basically central government is not really land intensive government. It's the state governments which have got most of the land, and they have their also organizations to handle it. This is something where a lot of CPSCs where we were lying closed or under closure haven't been able to close down also, because they have, although the liabilities have been extinguished, they have not been able to dispose of the assets, particularly land assets. And one of the important constraints which we studied, we found that there was little capacity in this. Similarly, we may have certain agencies, certain areas where it's possible to actually use the land for much more productive purposes, including urban renewal. To some extent, Ministry of Housing and Urban Affairs has done a lot in Delhi, where they have used that land and used the FAR to create a number of dwelling units at free of cost to the government because of the use of the FAR. But similar such things have not been done in many other cities where this land might exist. Now, so this is an organization which is actually, to start with, will be able to bring in the capacities that we have been talking about. And they would be able to actually get to service some of those requests from different other agencies and ministries to do that. And if they are able to succeed in concluding the transaction, they can always grow. To start with, they can start small and then they can grow. But this is something which has an authorized capital of 5,000 crores. So it's potentially, it could be a big organization. But what matters clearly is that we are able to bring in the best of the capacities into this organization while we do that. Department of Public Enterprises have been interested going forward to set up this organization.
All right. So my last question to you before we let you go is that the government has always been receptive of investor suggestions, be it ongoing or future transactions. What kind of message would you like to give investors here who have joined us? What would you want to convey to them?
No, as I said, that we have different windows in which the investors are getting in. There is a disinvestment window, typically listing opportunity like LIC or many other opportunities that we might have in dilution of stake sale. Then the second window is, of course, privatization, where the strategic disinvestment with management control takes place through a pipeline, which we regularly advertise. It's available on our website. We also interact with investors and roadshows and so on. And the third, of course, is the asset monetization window, where a number of ministries also collaborate. And Niti Aayog also takes care of broader monitoring role in bringing the ministries together. So all these three possibilities are there where this thing is there. This is not to count for tremendous other opportunities that exist, whether it is PLI scheme for direct capital formation, or in general the capital formation and this thing in the green field or brown field, or in other IBC related kind of a thing where investors are there. So there are different opportunities. The issue is that a capital scarce country like India needs to optimize the capital. And we need to have our capital, generating more output wherever we can. And that will add to the growth and employment.
Great. Thank you so much for your time, sir. We really appreciate it. Ladies and gentlemen, let's give him a warm round of applause, please.
Thank you very much, sir. You're not present here with us physically, but we would like to send you the memento to your office, sir. Once again, namaskar, sir, and thank you so much कि आपने आज हमें अपना वक्त दिया.
Thank you. धन्यवाद. बहुत-बहुत.
Ladies and gentlemen, that was the Honorable Secretary, and it's always very important for industry captains to know what the government is doing and how they plan to navigate this area in the years ahead. Coming up next, a fireside chat, riding the fintech wave. Let's get insights on where the fintech sector in India is headed and explore what more can investors and governments do to strengthen this ecosystem. Once again, I'd like to invite on stage Leslie Demont, Executive Editor, VC Circle, and he is in conversation with Upasana Taku, co-founder and COO MobiKwik. Please.
Hi, friends. If you remember, we just had a lovely conversation on the great tech wave. Now, one part of that great tech wave is also the fintech sector. And I was looking at some of the figures which I was confirming with. So I have Upasana Taku, who is the co-founder and CEO of MobiKwik, a major leading fintech player in the segment. Now, if you look at some of the figures, one, of course, that the Indian fintech sector is the third largest globally. So that itself amounts for a lot. In India, too, other than edtech, a lot of funding has gone into fintech. The overall market size of the Indian financial services segment was $500 billion in 2021. The fintech market touched $31 billion, according to a Blink investment report. Now, Indian fintech industry has been able to receive more than 25% of all the startup funding within India. Now, that itself, I think we need to give us an applause for the sector, please. So 23.7 billion kind of total funding raised in India. I think there are some 10 unicorns, some 52 unicorns, and the areas are like digital payments, digital lending, insurance, investment tech, neo-banking, banking infrastructure, and so many more other things. Now, MobiKwik, which is one of the largest mobile wallets in India, is also, I think, one of the largest or the leading player in the buy now, pay later, BNPL segment. I think some 25 million, 24, 25 million users that you have. So Upasana promised me before walking up that let's make it a little of the fun. So this is the last session of the day. Let's make it a little fun segment. How much more fun can you make it in the fintech sector? What's happening in that?
So, see, I think this is an investor conference. So fun is all about money and making money. So it's about getting a return. I think it's not just about fintech in India drawing the largest amount of FDI recently, and also in terms of unicorns that you mentioned. But I think you should all keep in mind that out of the 800 plus unicorns globally, the largest, 162 plus, are from fintech. So fintech is exploding globally. And if I could say, while fintech India is the third largest fintech market right now, I totally expect that in the next 5 to 10 years, India fintech will be the largest market. And there's a reason for that, guys. It's very simple. A billion people country, 600, 700 million Indians have a bank account, but we all know that the number of people who have credit is in the range of 50 to 70 million. Number of people who have access to insurance, savings products, investing products, everything is sub 10%. So 90% market available, many players can be created, can flourish. If there is a sector on which you should go long only, it has to be fintech. And within that, I would say FinTech India, because we are all sitting here in India, I would say that short-term incidents and performance of one or two players cannot be the basis of creating trust or mistrust on a sector. One has to really take a view of the number of companies till date, every day, every month getting formed and collecting checks from investors and building innovative products. So FinTech India, whether you like it or not, the government is totally in the favor of digital India. I'm saying even if it weren't, half the country is 25 years of age or younger. India is bound to go digital. मैं कुछ करूँ या नहीं करूँ. Indian fintechs कुछ करें या ना करें. This country is going in the direction of fintech, and that's just it. That's just a fact. Can't do anything much about that.
It's a very strong pitch. And I like the way you made this pitch, because I think it's very interesting from a point of view of looking at the digital ecosystem, the way, I mean, Vikash did speak about it from SoftBank, about the numbers that we have, the internet numbers that we have, the number of smartphone users that we have, number of apps that we have, and the entire digital mindset that we all have. Today, people just swipe, even a small little guy sitting on the corner has that, swipe a QR code and do the payments. Now, you also made a very interesting statement saying that, when we look at this market, just the action of one or two players should not reflect on the entire thing. We'll not take any names out here, but we all know that the fintech sector, the running is not as smooth as it should have been. Given the fact that the fintech till 5 to 7 years, we hardly heard about fintechs, but they have already disrupted the banking sector, made the banking sector sit up and take notice. And also, at this point in time, as we rightly, when we were talking earlier also, you all are also complementing and filling in those gaps. Now, can you explain a little as to what kind of gaps do you see as you go further? You have already, from the fintech sector point of view, you have already filled in a lot of gaps. So what are the other kind of gaps that you're looking at to fill in?
See, there are very simple and basic gaps even today. See, UPI has happened. Digital payments is the first bastion of fintech. Today, 300 million Indians are transacting digitally. When we started 10 years ago, 10 million Indians used to transact digitally. So we have come a long way. But I mean, we are at the tip of the iceberg. When we speak about, a loan getting disbursed instantly, until 2 years ago, most banks and financial institutions in India did not think that it was important for a credit product to be disbursed completely digitally. There used to be paperwork and process, physical process associated with it. But COVID has changed that. Eyes have opened at the largest financial institutions also. And that's where a fintech and an incumbent institution partnering, is creating rapid impact. In addition to this, you see a lot of companies now looking at solving things for the small business. You see whether it is working capital, whether it is credit for the merchant, all those things happening. Then you look at very interesting innovations that people are doing for young India, so to speak, which is that, save a little bit, invest a little bit in MF, invest a little bit in gold, but whatever it is, create the habit of investing digitally. Almost like you are keeping a habit of, exercising. That's the way that culture is getting built. If you think about the larger sort of, the larger thought there, I would say, is that several years ago, we saw banks getting created in India. Right? Today, we have in the range of 100 banks or more. 20 years ago, we saw NBFCs, etc., getting created. Today, we have so many large NBFCs. I think that is the way you should think about fintech as well. The number of problems that are there even today in terms of fintech in India, they require lots of large companies to come in, build, and fill in those gaps. You should expect that just like you can count the top NBFCs in the country that have gotten formed and have scaled up in the last 20-25 years, you will see similar things happen in the next few years. This concept of completely digital bank, neo-bank, open bank, whatever you want to call it, abhi tak we don't have that license in India. So, Singapore has it, UK has it, many global countries have created that framework. We haven't seen that in India. But I would tell you that that is one macro, that is one trend that I think is going to come together. Because what's happening, like even if I look at my own company or if I look at some other peers, we have licenses for payments, we have licenses for doing lending, we have licenses for doing insurance distribution. Someday all of this is going to come together and a digital bank kind of framework is what is going to evolve. Digital distribution, digital banking, the way it had been imagined 10 years ago is going to completely change 10 years out. Because those are products not being created for people like you and me. These are products being created for an India that is not yet served fully on financial services.
But when there's such a big opportunity, and when I look at those numbers, now for instance, like India has $16.5 billion, 10 unicorns. But when I look at UK and Ireland, it's $45.73 billion with 18 unicorns. Look at China, it's $61.2 billion with 28 unicorns. And when I look at the US, it's $207 billion with 94 unicorns. So what is it that we're doing right? We have already mentioned. What is it that we need to do better, or we are not doing as well as the other companies, other than, of course, you said licenses part of it?
So see, there are 2-3 things. I think firstly, in India, we have a very nice sort of microcosm of innovative entrepreneurs, regulatory bodies, financial institutions coming together and creating products and services which are completely disruptive and at the same time have mass appeal, mass adoption. Now, in China, when the fintech revolution came several years ago, the regulatory frameworks were not as set in standard. So they got a lot of opportunity to disrupt and do sort of go freewheeling in a manner before the frameworks were created. That is not the case in India. You know, from the beginning, you know, the number of P2P lenders in India is very small and the scale is also not very substantial. But the P2P lending guidelines were already well documented several years ago. Similarly, in many sectors, our guardrails are already created. I'm not saying that it's wrong. It's good to have guardrails that creates trust for the consumer, trust for the first-time adopter of digital. But I think that it will take a little bit of time. We have seen progress in the last 10 years. I think the level of progress you will see in the next 10 years is going to be at least 5x stronger and faster than what we have seen in the last 10 years. You have to wait for India to have 500, 600 million digitally transacting people. And that's when you will see the magic coming together. All these valuations, these returns will start coming in, but you have to invest now.
Okay, but while we are going to have that kind of patience and perhaps the entire community, the government policies and everything will fall in place, we will have the patience. But one of the concerns as of now is basically that while all fintechs are making revenue, I mean, not only the fintechs, it's all about all startups for that matter, tech startups, the overall startup system, is that while you all make revenue, profits are not that easily coming. So where are the profits and when do investors actually see profits?
So see, I won't say that profits are not necessarily coming. I'm happy to inform you that we just turned first quarter profitable in December 21. I also know that there are several merchant side fintechs that are profitable. There are quite a few actually. I think that in a consumer business, to expect from day one there will be profitability, I think that will be a little amateurish. If you want scale, then you have to wait for the business to scale before it can start generating profits. We are seeing that with scale, operating leverage is coming in, and so profits will quickly build up as the revenue keeps scaling rapidly. I would say that what the investor community should look for is founders and teams that have the right fundamentals and where they are trying to build a business with scales at positive contribution margin. I think that would be a key guiding principle for a consumer-facing fintech. I think you have to allow the companies to grow a little bit, but cash burn also can be done in the right way. Not all cash burn has to be where, you know, paisa bas uda diya aur uska koi return nahi hai. I think you can invest smartly and entrepreneurs can also build smartly.
And when do we see more fintech IPOs, like a lot of these IPOs, I mean, overall, again, this also is applicable to the entire startup sector, the back burner for now, yours including. So when do we see these kind of IPOs giving more money in the hands of investors also?
So I think 21 was a remarkable year, right? We saw quite a few tech IPOs come to the market and do really well. I think Zomato, Nykaa all set the stage. And of course, we are where we are right now, thanks to the conflict and everything else happening from a global perspective. I think that many companies in the consumer tech and fintech area are ready. They have scaled, they have substantial revenues, upwards of $150 million annually. And many of those companies also profitable, by the way, in our peer group. Many of them are ready. They have their DRHPs filed or approved. So I think they are all waiting for the markets to be normal and not as volatile as they are right now. And hopefully as those markets stabilize, we should see another flurry of tech IPOs come to the market, and hopefully they'll be able to get the trust of the investor community.
Good. I'm glad to see that kind of bullishness out there, and it makes a lot of sense also. It's good for the entire ecosystem. We can take a couple of questions before we wind up for the day. Anybody who wants to ask a question?
I think people are waiting for their beer or wine or choice of cocktail.
Okay. So I guess they're making you get off lightly, and I think we should take the cue. So thank you very much for your time, Upasana. It's been a pleasure talking to you, and I like the honesty of the answers out there. And I'm sure people would understand where the fintech sector is going. I think the important take-homes here is that, yes, the fintech sector has been going through its ups and downs, but so has every other company, so has startups, and we are seeing an uncertainty in the overall kind of market. There's a whole pandemic out there, still to turn endemic, and there's the Russia-Ukraine war that is there, which nobody knows how it's going to pan out. So among all the uncertainties, there are these startups that are doing their best to keep their head above water and also make profits in the thing, however meager they are. So please give her a big hand.
Thank you.
Thank you, Upasana. Thank you so much for this session. And Leslie, please do the honors with thanking her and presenting her with this memento, a token of our gratitude. And please come together for a photograph. Thank you once again. And that, ladies and gentlemen, was day one at the Mint India Investment Summit 2022, where we Indians put the arc lights on investing for India. In the words of Rajinder Krishnan from the film Sikandar-e-Azam, जहाँ डाल डाल पर सोने की चिड़िया करेगी बसेरा, वो भारत देश होगा मेरा, वो भारत देश होगा मेरा. But let's not just talk about prosperity, let's also say alongside, जहाँ सत्य अहिंसा और धर्म का पग पग लगेगा डेरा, वो भारत देश होगा मेरा, वो भारत देश होगा मेरा. So armed with the values of true knowledge, Atma Bodh, right conduct, Satya Karma, selfless service, Niswarth Seva, bond with divine, Sambandh, unconditional love, Prem, friendship, Maitri, one family, Ek Parivar. Come, let's build a new India that is a sum total of transformed humans and transformed human systems. Here's to transformation, as says Maitriya Dadashriji. It's the only way forward. Have a good day ahead, ladies and gentlemen. Please join us for cocktails and dinner. We will see you all tomorrow. Registrations will start at 9:30 a.m. sharp and the first session at 11 a.m. sharp. Namaskar.